We're at a world now where there's heightened uncertainty.
If we have a peace deal, then we could have a relief rally in markets.
The market has been volatile during this period, but not a tremendous amount of downside yet.
The market is pricing in that there's going to be a resolution.
We are going into an area of really uncharted waters at this point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, extending the uncertainty. President Trump says he's extending talks with Iran for 10 more days as the energy market is considering a closed strait until at least April 6th. It's leaving oil at triple digits, leaving bond yields at the highs of the year. The uncertainty persists.
So what have we learned this week? It has been a tumultuous week, and one potential takeaway could be that the Truth Social diplomacy plan is losing its punch when it comes to propping up markets. Yesterday, we got this Truth Social post that you were talking about from President Trump talking about postponing that deadline. We saw the worst one-day sell-off before that posting in the S&P since the war started. Now we're still seeing equities lower. We're still seeing bond yields higher. We're still seeing oil prices higher. That is the takeaway for me.
This is the problem. We've replaced near-term escalation risk with an extension of the uncertainty. Persistence is the problem this morning. If the strait closure persists, triple-digit crude persists. If that's the case, you don't need oil to keep going on higher. You just need oil to stay at these levels to cause sufficient problems, which is why if you check out the bond market this morning, 2s, 10s, 30s, two-year yields back to where they were Monday morning before that post on diplomatic talks. 10-year bond yields higher than they were on Monday morning.
And when you take a look at Japanese two-year yields, they're at the highest levels going back to 1996. It's not just a U.S. bond market move. It is a global bond market move as they reckon with the potential of rate hikes coming from central banks around the world in response to oil prices remaining where they are. We keep talking about asymmetric risks. The longer this goes on, the more of a sea change people see with respect to inflation, downside risk to growth.
And we're tracking the troop movement. This from the Wall Street Journal. Check out this report. The Pentagon looking at sending up to 10,000 additional ground troops to the Middle East to give President Trump more military options. That's hanging over this market as well.
Absolutely, because if those 10,000 troops are sent to the region on top of the Marines and on top of the already deployed soldiers from the 82nd Airborne Division, that would signal to this market that this potentially would be a longer, more protracted war, which is why potentially you can see crude stay higher for much longer. We should note this right now is just a report, but it does show that the president is keeping his options open.
It just eats away at confidence. It eats away at the Fed's easing bias. It eats away at potential economic growth.
Why send troops there if you aren't going to use them? If you have this hardening line from both sides, and this is already going on for a longer period of time, and ships are not getting through the Strait of Hormuz, people are pricing in a slightly new regime, which is what you're seeing coming through the bond market, which potentially could be the real signal that people need to pay attention.
I think what's going on the Strait, obviously, is of critical importance to this White House. The president talked about it a lot yesterday when I was in the cabinet meeting. But then this morning, you see Iran says that the IRGC turned back 3 container vessels through Hormuz. So you think potentially they're allowing more individuals to come in, more vessels to come in if you pay the Tehran toll. But right now, this morning, they're turning back some vessels. And this is a massive problem for this White House.
Equity futures this morning down by about 0.1% on the S&P 500. Coming up this hour, Russ Koesterich of BlackRock as the president extends talks. Kevin Burke of Clearview Energy Partners with crude still pushing higher. And Joe Davis of Vanguard with policymakers warning of rising inflation. We begin this hour with our top story. President Trump extending talks with Iran for 10 more days. Leading our coverage out of the region, Bloomberg's Jumana Basechi joins us now from Dubai. Jumana, it's another 10 days of uncertainty.
Yeah, well, you know, on first blush, this actually came as a relief to the nations in the region. The strikes on infrastructure, on key civilian infrastructure, both against Iran, but also potentially in retaliation against the Gulf states, pushed back by 10 days. So that was the, I would say, short-term reaction. But beyond that, there's still a lot of skepticism about the state of these talks, whether they're actually happening, whether the Iranians do want to engage. And the Iranians, at least rhetorically, are not signaling that any discussions are taking place. And in fact, the Iranian Foreign Minister Abbas Araghchi gave an interview to local TV yesterday, and he said that they're not engaged in any talks to end the war. They don't have plans to engage in those talks. But the U.S. had sent messages to them via Pakistan, which is in line with the reporting over the last couple of days. But there is no sign whatsoever that this in-person summit that people had been talking about is set to take place. So that is the diplomacy angle. But at the same time, in light of what you were just discussing, I think we really are going into a critical weekend in terms of the mobilization of troops that the U.S. is amassing in this part of the world. And we've been reporting over the course of the last couple of days that there are 2 Marine expeditionary units making their way. Our expectation is that the first unit will arrive in a couple of days. The next unit should arrive in mid-April, just to give you an idea of the time frame here. Wall Street Journal reporting overnight that the Pentagon are also considering sending 10,000 troops alongside infantry and key vessels as well. And so the takeaway from all of this is the U.S. is preparing for perhaps another stage of escalation. And you've got to assume that once all of these new military assets are deployed, they are going to be in striking distance of Iran or Karg Island, which is the key export island, or there's going to be some form of an attempt to forcefully reopen the Strait of Hormuz. There are little islands situated nearby as well. So the overarching question as we go into the weekend perhaps is less about whether diplomacy is going to yield anything, but actually what the U.S.'s plans are on the ground, if there is a plan.
Jumana Basenji out of Dubai. Jumana, appreciate your time. Stay close. No doubt we'll get some news throughout this morning. The base case at the start of this war, it won't matter to markets if it's days and not weeks. Remember that? And then it was weeks and not months. And now here we are at the 1-month marker and a new self-imposed deadline of April 6th. So we'll be talking about this into April based on this guidance.
Prediction markets are saying that through the end of April, this could potentially be the reality. And the issue is, and people are watching this, you don't just open the Strait of Hormuz. You don't just say, OK, green light, go ahead. This is the issue, the lag time. And so as people try to price that in, it seems like another number of asset classes are really starting to respond.
It's the reality of production in the region. The longer some of the production is shut in, the harder it is to ramp up production coming out the other side.
And that's why Macquarie this morning is out with a note saying if this is protracted, it lasts a lot longer. You're looking at $200 a barrel when it comes to oil. We actually know and had reporting from our colleagues in Washington that the Treasury Department was modeling out what the impact would be for that number, $200. So that is another key threshold everyone is watching.
Let's get to the view on Wall Street this morning. Russ Koesterich of BlackRock writing the following. While our base case is no recession, the energy shock suggests a moderation in near-term growth expectations. Russ joins us now for more. Russ, welcome to the program. You and the team have been de-risking. Where and what in?
Good morning, Jonathan. We've been de-risking across the board. We've really been getting closer to benchmark in our equity positions, closer to benchmark in duration. We've been bringing down some of the factor risk in the portfolio. And there are a couple of reasons for that. The obvious one is we don't know how long this is going to go to continue. I think you used exactly the right word a few moments ago, persistence. And the longer this persists, the greater the risk to inflation, the economy. But the other reason for de-risking is that there really aren't any hedges in this context. In 22, the dollar actually was an effective hedge against the sell-off in equities. Last decade, treasuries were providing some downside when there were concerns about growth. In other circumstances, gold has been working. Nothing is working right now. So really the only thing you can do within a portfolio, other than making some adjustments at the stock level, is to bring the risk down.
I often say, in moments like this, the bonds don't work, they make things worse. Yields right now up again by 4 basis points for us. 10s at 4.45, 2s at 4%. Lisa and I yesterday spent a lot of time on a week 2-year auction, a week 5-year auction, followed by a week 7-year auction as well, Russ. What is happening there? What's behind those moves?
So this, to me, is actually maybe even a bit more interesting than what's going on in equity markets. It's very easy to understand. You have an oil shock, higher inflation, hit to growth, and what's happening with stocks. The bond market, I think, is more nuanced. Obviously, the bond market is reacting to what will be an increase in headline inflation. That said, as you point out, I think most people realize higher energy, not just oil, but natural gas, higher food prices, higher fertilizer prices, all of which leads to an increase in headline inflation. But the problem is, one, that doesn't necessarily flow into core. And 2, it is also a drag on growth. And it's happening at a time when the labor market is already a bit soft. So the notion that you just want to keep selling bonds into this, To me, that's less obvious. And I do think at some point, if the concerns about growth continue to build, if we do have $100 or higher oil for a prolonged period of time, there is a question about at what point you want to start bringing bonds back into your portfolio as a hedge against weaker growth, which is going to be another risk we're going to contend with.
Part of the reason why it's been so hard, Russ, to get a handle on when that point is, when people should step in and buy duration, is it's unclear exactly what's behind the sell-off. Is it technical? Is it a question of central banks that are selling what they can to raise money for possible fiscal stimulus? Is it a potential concern for a fiscal response to any kind of slowdown in the future? What's your take on this?
So I think it's a great question. To my mind, one of the things that's clearly going on is a pricing out of what would have been a number of rate cuts from the Fed and pricing in a greater possibility of hikes, particularly from the ECB. So is the front end of the curve is adjusting. You're seeing that movement throughout all of the yield curve. But again, if we're going to be in an environment where $100 oil persists, and I think, you all raised a good point a few moments ago, it's not as if oil is going to go back to 65 the second the shooting stops. There's been damage to infrastructure. There are questions about how long it takes to open the Straits of Hormuz. There is likely to be a war premium or a risk premium embedded in oil for many, many months. So if you're going to have that period of prolonged higher energy and all the knock-on effects, you've got to start to bring down your growth expectations, most of which were high coming into the year. And at some point, that probably does suggest bringing your duration up further.
Which is something that I know others, including JPMorgan, has been thinking of doing. Given all of this and given what we know in terms of the prolonged conflict, do you think that right now we're facing a market that is overly complacent when it comes to the growth shock that's coming down the pike?
I don't think it's overly complacent because I do think you've already seen a fairly significant adjustment. I also believe that, at least in the U.S., I think the situation in Europe is certainly more serious given their exposure to higher energy prices. I think the U.S. can probably survive 80 or 90 oil, still have a year when growth is positive. Of course, the difference is going to be that we're not going to get, or we're less likely to get, the type of above-trend growth that investors were expecting just a few months ago. And if you look at what the equity market has been doing, it's actually responding to that. The rotation that dominated back in late 25, early 26 was all about the broadening out. You bought cyclicals, you bought value, you bought international stocks, you bought small caps. To my mind, those trades were predicated on above-trend growth. As you start to price that growth out, you're seeing a reversal of many of those trends. Investors have been looking for more defensive parts of the market. And interestingly enough, they've also been looking at tech, at least on a relative basis, as holding up better in a world in which economic growth is not as much of a tailwind.
Hey, Russ, always got to catch up. Russ Koesterich there of BlackRock. Certain pieces of tech, maybe, but the Nasdaq 100 down almost 10% from the highs of the last year or so, and some individual names have been hammered. Microsoft down some 30% from the highs of last year. Meta hammered yesterday, down 15% so far in March.
That was fascinating. It's frankly breaking below a lot of the technical trends, leading some people to say this has legs. Is it because of disruption coming from new technology, whether it's overseas or domestically? Or is it the lawsuits with Meta coming under pressure for some of its social media controls? Tech is maybe the haven, but it depends where you look in tech, and that is an increasingly complicated story.
It's not just the war you've got to track, it's the situation with technology, AI disruption, etc., and this in private markets. Is this a flex from Oaktree? This headline we've just seen. They'll meet 8.5% of private credit fund redemptions in full.
100% it's a flex, because that's the headline they want everyone to see. Apollo, Blue Owl, all of you people, you guys can cap things at 5% and say, oh, I'm so responsible. I'm going to meet it in full and have no problem with it. So, sure, this is definitely going to be a time where they're all kind of trolling each other. And this is how I read this headline.
More on that story a little bit later this hour. Equity futures here down 0.1% on the S&P, with an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Good morning, John. President Donald Trump pushing back his deadline for a deal with Iran, saying he will pause attacks on the country's energy sites for 10 days. Trump also saying talks with Tehran are going, quote, very well. Iran saying it's waiting on a response from the U.S. after rejecting its peace plan and offering its own conditions to end the war. A legal victory for Anthropic, the maker of the chatbot Claude, winning a court order blocking a Trump administration ban on government use of its AI technology. Anthropic arguing the ban could cost it billions in lost revenue. And the Senate passing a bill to end the Department of Homeland Security shutdown. The bill still needs to pass the House and be signed by President Donald Trump. Ahead of the bill passing, Trump saying he would sign an order to pay TSA officers. That's the Bloomberg Brief. John.
Hey, Yahara, thank you. More from Yahara later this hour. Up next on the program, pushing allies to step up.
Very little of our energy comes through the Straits of Hormuz. It's the world that has a great interest in that. So they should step up and deal with it. They should be doing something about it.
Up next, we'll catch up with Bloomberg's Colonel Wayne Sanders. He joins us next, live from New York City this morning. Good morning. Biggest one-day loss since the war started in yesterday's session this morning. No pickup, no bounce. Even as the president extends talks, he extends uncertainty for this market. The Nasdaq is down by 0.2%, and this move continues. Weak 2-year auction, weak 5-year, soft 7-year. Bond yields up again, 2 basis points, north of 4% on 2s, on 10s. 4.46. Yields right now are higher now than where they were on Monday morning before the president declared there were talks.
We're now pricing in a 50% chance of a rate hike from the Federal Reserve by October, a 75% chance for an ECB rate hike, at least one, through the end of the year. And right now, it's a real question mark. If this goes on for a longer period of time, Christine Lagarde coming out and saying, we cannot be humble about our goal, which is getting inflation down to 2%. So even if it is a marginal move higher, we have to take action, seeming to confirm the hawkish bias.
It's pretty simple. The longer the talks go on, the longer the strait is closed. That's the view of the market right now, which means crude stays at these levels. Brent around triple digits, 110. Almost 110 this morning. WTI, 96.
Or the talks are basically just a distraction because the President of the United States is making sure that the right personnel is in place so that he can open the Strait of Hormuz. But I think one thing to really understand is that even if the U.S. military was able to open up the Strait of Hormuz, maybe also with a coalition, the FT is reporting the UAE would be willing to join this sort of coalition, it is not going to be normal flow of traffic in terms of volume that we are used to. So regardless, it is going to be weeks and months that this is going to be impacting the energy market.
Persistence is the problem. Under surveillance this morning, pushing allies to step up.
Very little of our energy comes through the Straits of Hormuz. It's the world that has a great interest in that. So they should step up and deal with it. It can be open tomorrow if Iran stops threatening global shipping, which is an outrage and a violation of international law for all these countries that care about international law. They should be doing something about it. There was a couple of the leaders in Europe who said that this was not Europe's war. The United States is constantly being asked to help in a war, and we have more than any other country.
So here's the latest this morning. Secretary of State Marco Rubio at the G7 foreign ministers meeting in France, with the U.S. seeking support for opening the Strait of Hormuz. Bloomberg's Ollie Crook joins us now for more. Ollie, what's the update on the talks?
Yeah, for the G7 foreign ministers gathered here, you have Marco Rubio just in that room there behind me having discussions with the foreign ministers of other G7 nations, but also very interestingly and very relevantly, the Saudi foreign minister who is here as well. For them, you know, it's going to be a fact-finding mission to get from Marco Rubio not only what the U.S. war aims are in Iran, of course that has been the big question for everybody, but also further to that, what are the specific things that are being asked of European allies? We've of course heard from Donald Trump yesterday saying that NATO had been effectively useless to them in the Straits of Hormuz and that he won't forget it. The question will be specifically what kinds of things the Europeans, the G7, can present. What we understand now is under discussion at a high level is a coalition of more than 30 countries. We had the NATO Secretary General Mark Rutte speaking yesterday about that would be involved in some way, this coalition of the willing to open up the Straits of Hormuz. Now, there are several questions attached to that. The first is willing to do what and willing to do it when. I've spoken to a number of officials here, including the Canadian foreign minister, a spokesman for the French here, who had originally floated this idea of being actively involved in opening up the Straits of Hormuz, and I couldn't really pin anyone down in terms of the timing. They say really after the majority of the war is done, but as you know, the war doesn't necessarily end cleanly. I think there's also an effort here by the Europeans to link the war in Iran with the war in Ukraine, saying that the Russians sending drones and intelligence are actively targeting U.S. troops and U.S. lives. That is a line they want to draw, but as you say there, John, the line that Marco Rubio wants to draw is that everybody's saying the war in Iran is not our war. The Americans say Ukraine is not our war, but we're still helping.
Ollie, it's good to catch up. Stay close. We'll catch up with you later if we see any headlines. Ollie Crook there on the ground in France. Joining us now to extend the conversation, Colonel Wayne Sanders, Senior Defence Analyst at Bloomberg Intelligence. Colonel, welcome to the programme. Can we talk about the potential for a ground operation? Could you describe what that might look like and what the objectives would be?
Absolutely. When you think about ground operations, especially with the limited number of troops that are on its way, it is something that would probably be limited in scope. It's probably, you look at the 2 Marine Expeditionary Units that are on the way. The first one's coming from the USS Tripoli, should be there over the weekend, and then the USS Boxer in the beginning of April. But any type of insertion, right, is going to require air superiority, which we already have. So you would actually see an uptick in overflights that would allow for those type of security operations to make sure secure passage to go there. Whether or not they're being airlifted in or whether or not they're actually going into the strait. We think about like Karg Island being one of the areas where you could potentially see boots on the ground because it is limited in terms of its mainland Iran status, if you will, to be able to go there. But when you look at this, one thing I do want to bring up is the difference in troop numbers that are going out there now versus previous escalations, because people are talking about the ground strike portion of it. The U.S. troop count when in Desert Storm was 697,000. The amount of people at OIF, at Operation Iraqi Freedom in 2003 in Iraq, that was about 160,000. So we're only talking right now at about 10,000. Even if you bring in another 10,000, you're talking about 20,000 total. So a lot less. So it would be very, very surgical in terms of what they're trying to accomplish.
If it's surgical, does that mean that this wouldn't be a garrison of troops set up at one of these islands?
Well, that's about all you would be able to do with that, right? Is because you would have to be able to set up enough security, bring in logistics, refueling, everything that's required, air defense assets that you would have to set up to be able to provide security for those infantry and Marine Expeditionary Unit forces to be able to hold that. The straits are pretty long. So even when you're looking at where the choke points are and being able to do that, you still have to figure out how are you going to make sure that you can get rid of some of the asymmetric threats that can show up with shoulder-fired missiles. Because at this point in time, as you've seen, it doesn't matter. It doesn't have to be a full closing. Iran at this point in time has just had to threaten those attacks, and it has stopped most of the flow.
Does the president's new deadline of April 6 match up with the ability to get all of these troops in place?
I think it does a little bit. His original deadline of this weekend, right, was tied to the Marine Expeditionary Units coming in. There are additional capabilities that are coming in, and one of the other things we've seen President Trump do is he doesn't like to choreograph his moves. Most of the success has come from ones that hasn't been choreographed. Operation Midnight Hammer, nobody knew it was coming. And then even when the strikes originally happened on February 28th, same kind of thing here is that extension allows him to have additional options, even if he was going to do something with just one Marine Expeditionary Unit as they come in, or the 82nd Airborne, the elements of them that are coming in as well. It gives him freedom of operations at that point in time. There are more options available now as opposed to having to answer to a deadline that was set for this weekend.
Colonel, appreciate your time. Fantastic framing. Colonel Wayne Sanders there of Bloomberg Intelligence. We've talked repeatedly through this week about two-way risk. The two-way risk persists.
Even though there was a dialing down of the temperature, and this is the key point, a question of even if you don't necessarily have this bimodal outcome over the weekend, there still is a feeling that we don't have a sense of resolution. Why would anyone take big risk at this moment, especially with the lingering after effects?
You've got to remember who turned up the temperature to begin with. The original threat came from the US side to bomb energy plants in Iran, and that moved from an immediate threat to a 5-day period of talks, and that's now moved to a 10-day period of talks, taking us to April 6th. So you can turn the volume down all you like. This market's been focused on one thing, obsessively. The volume of traffic going through the Strait of Hormuz, what it means for production in the Middle East, the damage done there too. And if this persists, this story doesn't change, it gets worse.
And frankly, that is exactly why this is so different than what we saw during Liberation Day, because you could turn the temperature back down and it wasn't the Strait of Hormuz and it wasn't a physical goods. The fact that now UAE and Saudi Arabia are coming out and saying, you better not leave, and then leave this quagmire with us to deal with, gives you a sense of how this could develop.
I'm struck this morning. 2 Chinese vessels tried to go through and they had to make a U-turn.
If you're hoping for a change for the better, you're not seeing one right now. Coming up on the programme, we'll catch up with Kevin Burke of Clearview Energy Partners, with oil rising as traders brace for a longer war. Live from New York City this morning. Good morning. You're watching Bloomberg TV. So we had a self-imposed deadline and the president has delayed 10 more days of talks. The price action might not be what you expected. This is seen as 10 more days of uncertainty, 10 more days at least of the Strait of Hormuz being effectively closed. Equity futures on the S&P down by 1/10% following the biggest one-day slide we've seen so far throughout this month, throughout this war. In the bond market, 2-year, 10-year, 30-year yields making new highs for the year. The 2-year, north of 4%, 10s at 446 and up 4 basis points. On the front end of the curve, up by 2. And this is following some pretty soft auctions through the week so far.
Yeah, and Russ Koesterich said it perfectly, which is you can't hedge anywhere, and it hasn't been a hedge in the 2-year yield. It hasn't been a hedge in the 5-year yield. And in the 7-year yield, when we got the auction yesterday, the similar kind of messiness, albeit even less, actually, ironically, than the 2 and the 5-year. The 60-40 portfolio, worst monthly performance right now, going back to 2022.
You don't need crude to go up a lot from here. Crude just holding on to these levels causes its own problems. And we're holding on to these levels, 110 on Brent, 96 on WTI. That's a problem. Once again, the P word. It persists.
It persists, and it is a problem because this is a global market. I was struck yesterday by the Treasury Secretary saying the global oil market is well supplied. Well, if it's so well supplied, then why are we taking all these extreme measures? Why are developed countries having to go into their stockpiles and release? And why is the president threatening all these troops to open up the Strait of Hormuz? Because it is priced globally, and right now, yes, the United States is dealing with this, but if this persists, a lot of issues are going to be prolonged. And it's not just crude. Fertilizer. You have to make these orders in the next 5 to 6 days, and we are reliant 20% on imports of key fertilizer ingredients.
There's a lot of options on the table heading into April 6th as we count you down to the opening bell. 3 hours away. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We start there with oil, with the U.S. energy producer Battalion up 14% in the pre-market as it tracks another rise in oil prices. And I thought Deutsche Bank put it best this morning, saying that while President Trump's 10-day delay for strikes may ease immediate risk, there's still no clear path to a resolution with Iran. So that is keeping supply concerns front and center and benefiting these domestic oil stocks. And it's not just oil, gold moving higher as well, and that is benefiting mining stocks like Hycroft up 2% in the pre-market. And what's notable here is that during this conflict, we have seen oil and gold moving in opposite directions, but today we are seeing them move in lockstep, both rising. And we end on AstraZeneca, those shares up 3.8% in the pre-market after late-stage data showed its drug to treat a deadly lung disease helped alleviate symptoms. And analysts say that this one drug could bring in nearly $1 billion in annual sales for the company. So shares up on that news. John?
Yahara, thank you. Appreciate the update. More from Yahara in just a moment. On our radar this morning, President Trump extending his deadline for striking Iranian energy sites for 10 days. In a social media post, the president writing talks are, quote, going very well. Tehran insists it's not negotiating with Washington. The White House considering sending 10,000 more soldiers to the Middle East. A senior U.S. defense official reportedly saying the forces would be in addition to thousands of Marines and paratroopers already deployed to the region. And finally, the Senate passing legislation early this morning to fund most of DHS. The deal approving funding for the TSA, but not for ICE. The budget impasse jamming airports and disrupting travel around the country. The measure heading to the House for a vote as soon as today.
And really, the issue for me is, does this actually matter, given the fact that President Trump has already ordered that they get paid out of a discretionary fund? Has, in some ways, Congress absconded its function once again to the president, who is superseding them as they wait to vote on this measure? I just wonder how much pushback they get because suddenly there is more time that they potentially could continue negotiating this, given that perhaps TSA agents are already going to be paid.
2 things stood out for me. One, if the president had this authority and found these funds, why didn't he do it weeks ago before we lost all these people at TSA, before TSA workers were not getting paid? How difficult is that to continuously miss paychecks? I'll tell you this, lawmakers aren't missing paychecks. And 2...
And they're cutting lines.
Yes, and yes, exactly. And GOP leaders have for weeks resisting Democratic calls to say, let's just do a deal, let's pay TSA, and let's come back to the table and discuss what's going on for ICE and CBP. They said no, they said no, they said no. And guess what? Last night at 3 a.m. when we're all waking up, they're voting for it.
I don't know why politicians in Washington don't realize the following. They play this game where they want to make it about Republicans versus Democrats. If you're in that line, you just hate Washington. You just despise Congress. And you see this in poll after poll. There's one great poll about the handling of the economy. Are you happy with the handling of the economy by the president right now? And you'll see in that poll, no, people aren't happy. Then you'll ask them, do you think that the Democrats would handle it even better? And they'll say no in the very same poll. The consequence of this mess is not one wins versus the other. People just turn against Congress and the politicians representing them.
Everybody loses, essentially, is the way that this works. People lose politically and people lose when they try to travel anywhere. One individual who went down to Washington, D.C. to discuss with them this, who actually is in the industry, asked them, why don't you just pass this bill, get TSA agents paid, we'll resolve this issue, you guys can scrabble, fight over everything else. What they said was, nothing gets done if we remove this point of leverage. It's very honest, but my goodness, it does not read well in this society.
Not good at all, is it? Not good at all. Let's focus on crude, pushing higher once again with no off-ramp in sight for the war in Iran. Kevin Book of Clearview Energy Partners writing the blockage of crude through the Strait of Hormuz could be more than offset by SPR releases in the Americas, but inventory levels in Europe could drop if current conditions persist. Kevin joins us now for more. Kevin, welcome to the programme. This situation does persist, so let's assume, and it is an assumption, things can change. It's a self-imposed deadline. But if this continues through to, say, April 6th, what would that mean for this energy market?
John, good to see you. Look, we've got 10 more days for inventories to decline. The cold mathematics of inventory depletion are much like the cold mathematics of viral replication. If you go back to COVID, the problem was building around the world. Markets and really America missed it, and it's going to catch us.
Well, how much drawdown could the United States continue to do without going back and refilling the SPR?
There's room for the SPR to come down further, but not much room. And part of that's got to do with legislation and the ability to draw further under emergency conditions versus non-emergency conditions. Part of that's got to do with the practicality of the SPR. Having it available for the big crises means you want to keep some in reserve. If this isn't over in 10 days, maybe you want it around longer.
Kevin, if the U.S. administration knew that this was a possibility, and it always was, the president, I remember a year ago talking to him about this. He prefers a diplomatic route, but he was steadfast. Iran will never get a nuclear weapon. He's willing to deal with them the hard way. Why were they not refilling the Strategic Petroleum Reserve?
As you know very well on this network, the Secretary of Energy asked for $20 billion, or at least mooted the proposition last year. And in what was probably the most catastrophic mispricing of risk in recent congressional history, they gave him $171 million. So without money, you can't refill the reserve.
When it comes to the OECD stocks, how does that actually impact the price of oil?
There's a very strong inverse correlation between OECD petroleum inventories and the front-month Brent crude price. And it's one of the relationships you can count on for a reason. When there's less oil in stocks, if it can't come out of inventories and it can't come out of the ground, it can't come out of the strait, where's it going to come from? Prices go up.
Is this an oil problem, Kevin, or are we overplaying the oil aspect of this and underplaying the natural gas aspect?
I think the natural gas aspect is pretty significant at the margins. It's easy to overlook it in sort of the total energy picture. And frankly, the two are related in a very significant sense. 4% of the world's energy consumption in terms of oil and gas bottled up in the strait right now means that there's substitution fuel pursuits happening all over the world. In the last crisis, 4 years ago, we went from missing gas westbound into Europe, drawing liquids demand from petroleum for generation in Asia. Now those liquids aren't available either.
We do see, though, that the United States has been ramping up the production of liquefied natural gas and had previously been exporting a growing proportion to Europe in particular to offset the decline coming from Russia. How much do you see that continuing versus maybe a little bit of restraint on that front as natural gas prices in the U.S. also climb?
Well, they haven't climbed very much, and I think that's one of the significant takeaways of the LNG story here in the United States. There's still a great deal of missing connectivity that would provide for those prices to rise. There has to be some way to expand volumes in response to the deficit in global markets for there to be that kind of price response. And even then, we have a very flat supply curve. I think that when you look at importing governments, they're all going to be asking one question after this, and that question is, how can we make sure this never happens again? One answer is to diversify sources and routes. To the extent that routes are the solution, the United States can provide an answer.
That's certainly going to take time. Kevin, I want to finish on this, just a piece of scenario analysis, if you will. If there is a ground operation to take Karg Island to try and reopen the Strait of Hormuz, how do you suspect the futures curve would price that? Would it begin to price in a resolution to this war? Would it drag prices lower or push prices up?
I think we have to ask what the Iranian riposte would be to that, John. And I think the answer might be that they'll look westward at those cargoes going to the Red Sea, and maybe we see an activation of the Houthis in the next leg up in risk. So I'm not sure that's the answer we'll see in the market.
I think I understand where you think prices will go. Kevin, thank you, sir. Kevin Book there at Clearview Energy Partners. Because if the Houthis get involved, we got another problem.
Yeah, and yesterday I thought that it was fascinating, the interview that AMH did, the indication that right now Saudi Arabia is paying off the Houthis not to interfere with the Red Sea passageway. Gives you a sense of, the rule by mob that seems to be going on over there.
But that could change because obviously their biggest beneficiary is the Iranians. And at some point, the Iranians could say, we need to escalate this. We want to put the pressure up even higher. We want to move crude prices closer to a very painful threshold for this White House. And he could tell them to get involved. And all you need is one drone, one speedboat at the Bab el-Mandeb Strait, and this east-west pipeline that Saudi Arabia has been using to move 3, 4, 5 million barrels a day. Now that crude all gets stuck.
Brent crude right now. Brent 110, WTI 96. Let's get you an update on news worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Secretary of State Marco Rubio meeting with his G7 counterparts in France. Rubio may have a hard time gaining support from U.S. allies a day after President Trump complained about NATO countries not stepping up to help with the war in Iran. Nicolas Maduro appearing in a Manhattan federal court yesterday. You can see the court sketches there. The U.S. is pushing ahead with a broad drug trafficking and narco-terrorism conspiracy case against the ousted Venezuelan leader. And Oak Tree Capital Management is meeting all redemption requests for one of its private credit funds. According to a regulatory filing, the company is allowing investors to take out 8.5% of net assets from its strategic credit fund, which is equivalent to around $400 million. That's your Bloomberg Brief. John.
Yahira, thank you. The ultimate flex. Bramo was talking about it earlier. Everything just feels like a marketing campaign right now. They're all throwing shade at each other in private markets.
This is an opportunity for people to potentially gain market share and to show who the bad apples are and that they're the good ones. To me, this is saying you have to cap it. We don't. We're good.
The Oak Tree flex early on this morning. Equity futures right now in the S&P negative by a third of 1%. Up next, the inflation warnings piling up.
Moreover, the conflict in the Middle East raises additional risks.
I still see underlying inflation as gradually moving down.
The inflation risk is greater right now as a result of the Iran war.
We'll get to that divide in just a moment with Joe Davis of Vanguard. Uncertainty extended. Equity futures down by a third of 1% on the S&P, following the biggest one-day slide on the S&P 500 so far this month since the war started. The S&P at the lowest level we've seen since early September. On the Nasdaq, we're down another 0.5%. The Nasdaq 100 very, very close to correction territory, down almost 10% from the high of the last 12 months. In the bond market, new highs for this year: 2s, 10s, 30s, 10s, 446 up 5 basis points, 2 up by 3 basis points to 4.01%. This is the pain trade for me, Brahma. This is the pain trade for me. We've flipped from easing to tightening over at all these central banks, the Fed, the ECB, the Bank of England. And in this market, when you speak to anyone in fixed income, they talk about the value created in the yield curve and the opportunity to step in. There's so much doubt about this persisting, which makes it so much more painful.
If it continues to go up. And what you did see last week and this past week, long-term bonds have seen their second largest ever withdrawal, their biggest withdrawal going back to March 2020. This is according to EPFR and Bank of America data. And Michael Hartnett over at Bank of America said, expect policy panic to avoid recession. Guess what? He's looking for that yield curve steepener as a result of the fiscal response to avoid any kind of serious economic downturn. This is the potential pain trade that you're talking about.
Check out crude, Brent and WTI. There's 3 scenarios here, and we usually only talk about 2 of them. And these are the 2. The two-way risk that crude crashes from here on the back of a resolution, or things escalate and crude spikes to 150. What about the problems caused by just staying around these levels? That's the conversation I think we have to have this morning as we talk down another 10 days of talks between the US and Iran and Brent crude around 110.
Well, it's going to be very complicated and not really as much for the United States as is the rest of the world. You're already seeing some countries like the Philippines saying this is a state of emergency. Asia is still the front lines of this crisis when it comes to the energy shock, telling people work from home, take carpools, and then it's really going to start to hit Europe. And that's going to be a big problem. And I'm sure Secretary Rubio is hearing about it right now in France at the G7.
Brent crude 110.50, WTI north of 96. Under surveillance this morning, inflation warnings piling up.
Moreover, the conflict in the Middle East raises additional risks. Higher oil prices tend to pass through pretty quickly to gasoline prices. And higher gasoline prices can be particularly painful.
I still see underlying inflation as gradually moving down towards target over the next, 12 months.
I would argue that the inflation risk is greater right now as a result of the Iran war.
So here's the latest this morning. Federal Reserve officials raising concerns about the impact of the Iran war on inflation. Treasury yields setting new highs for the year as investors shift expectations from rate cuts to possible hikes. Joe Davis of Vanguard writing, the key indicators I'm watching are twofold. One is clearly just the labour market. The second has always been a wild card, the price of oil. Joe joins us now for more. Joe, welcome to the programme. Two time horizons. Let's start with the first. Quite short term. I want to start with the March data and the April data. What are you expecting to see in the March and April data?
Well, we're going to continue to see inflation that's somewhat stubborn. I mean, if you look back over 2 years, obviously some progress, but our theme going into the year before the events just in the Middle East was that the Federal Reserve was going to be a little bit challenged to deliver in the cuts expected because a little bit of this stubbornness in inflation. And so, again, that's before oil has moved. So we're going to see mixed signals, and some of it is dated given what we're seeing in the oil markets.
Joe, in line with that, how do you expect central bank communication to adapt, to evolve between now and the April meeting?
Well, I think we're starting to see it. You're going to have to talk tough on inflation. This is, central banks, generally speaking, have some scar tissue going back several years. And so I think the tougher you talk, the less you actually have to do. And I think that's where we're at. I think you're going to have to address the fact that although the oil spike will push up inflation, push down growth, you have to focus on the former, not the latter, just from a risk management perspective. I don't see the Federal Reserve hiking anytime soon, just because of the cross currents it'll do in labor market. But nevertheless, this notion of easing significantly because of the downdraft in the economy, you got to be careful with that timing, even if that would ever happen, because we need to see a lot of events unfold before we go down that path.
And Joe, this is the reason why when John says, what if oil prices just stay around here? Potentially that could be one of the more toxic scenarios for central banks, because they may have to respond more to ongoing inflationary pressure with growth continuing to hang in there, at least reduced, but at least positive. How do you see the Fed responding to oil prices staying here versus spiking higher or going back down?
I think that's the most interesting dynamic, what your conversation is this morning, because obviously if it collapses, we have obviously a risk on, and this is more of a return to other factors that we were watching. Obviously 150 price of oil per barrel starts to bring in the recession risk much more prominently, but it's a persistent around $100. You have to redo the calculus. I think that now that is a Federal Reserve that is very much on hold and is not going to get the disinflationary effect that you were banking on. And so I think that's the more interesting scenario. And I think that should be, more seriously considered than perhaps even the other two for the time being.
What do you think the bond market right now is pricing in, given the fact that we've had a repricing across the curve? Yes, there has been a curve flattening. Short-end yields have risen more than long-end yields, but long-end yields continuing to sell off with some auctions that represent real weakness. Is this people who are gaming out growth, rate hikes that persist, stagflationary types of situations?
It is doing both. I mean, we got a little fiscal in the background at the long end of the curve, but it is really oil, does it dominate on the growth side or on the inflation side? And again, I think there's a really healthy debate. I mean, we're talking about it this morning, 3 scenarios, not one. And so you're going to get really some volatility on the yield curve. I think the intermediate part of the curve probably looks the most attractive and potentially safest if you talk to our fixed income team. So again, I think it's premature to talk about a Fed easing because the oil hit takes down growth, just given what we've been. And the fact is inflation is not super high, but it's above target. And you have to reflect that in your timing, even if you're bearish in oil going much higher.
In the meantime, how isolated is the U.S. economy from the rest of the world? A lot of economists have come on and said that Europe faces a real problem, Asia faces a real problem. The U.S. is somewhat insulated because growth has been at a higher pace. You have the tech impulse. Is that sustainable?
It is. Again, it all depends upon where oil goes. What we would need to see to have really a downdraft in growth are really 2 things. It's not just the price of oil, which we all feel at the gas pump, but it's also the fact that we would need to see financial conditions really weaken. So the equity market here is actually the wild card. The equity market would have to start pricing in downdraft in earnings significantly so that it would pull back some of the business investment and high-end consumer spending. It would have to shake confidence of CEOs and on the consumer side to really, because those are the really 2 strong foundations for the U.S. economy, hence your point. So again, you would have to see that foundation really become rocky before we're starting to talk about Fed easing here.
Hey, Joe, it's good to see you. Thoughtful stuff and lots to think about. Joe Davis there of Vanguard on this economy and energy prices. Central bankers know what to do in extreme situation. When you hit extremes, central bankers will know what to do. If you gap lower on crude and you crash back down to 50, 60, opens the door to cuts. If you spike higher to 150, pushing 200, they'll start worrying about growth. Mike Gapen and Morgan Stanley will break this down for us a little bit later. If you persist at these levels, they're stuck and they don't know what to do. And we see this time and time again with the central banker. If you throw a recession at them, it's obvious what that central bank is going to do. You throw the middle ground at them, things get complicated.
Morgan Stanley, I'm glad you brought them up. They're the ones that say this $100 to $110 a barrel. That kind of range leaves rate hikes back on the table and potentially certainly no move from the Federal Reserve based on the ongoing inflationary pressure without that hit to growth. That, to me, is the most interesting situation, as Joe Davis said, and frankly, is one that this market is trying to grapple with.
Can we see a Federal Reserve that has to quickly hike rates to then get a growth shock and then unwind them, all while they have a leadership change at the top? I'm still confused about who will be running the Federal Reserve come May 16th.
You're not alone. Is it going to be Kevin Walsh? Is Chairman Powell going to be around for the rest of the year? Based on how things are trending right now, I'm not sure Chairman Powell wants to be around for the rest of the year, based on where things are headed.
Yeah, he would like to have this wrapped up. I think there is a sense of confusion about why there wasn't just an easy out taken so that we could resolve the subpoena, the investigation, and get on with it. Nonetheless, clearly the lack of clarity around the Fed reaction function adding to the volatility that we're seeing in bond markets and some of the messy auctions that we saw this week.
Yields up this morning by 2 basis points on 2s north of 4%, on 10s north of 440, with crude right now 110 on Brent, on WTI at 97. Coming up next, we'll catch up with Bob Michele of JPMorgan Asset Management, Tobin Marcus of Wolfe Research, the ECB Governing Council member Pierre Wunsch, and Sonal Desai of Franklin Templeton Fixed Income. The second hour of Bloomberg Surveillance is just around the corner as the uncertainty persists for global markets as the president extends talks for another 10 days between the US and Iran.
We'll really start to see that energy price shock feeding through in the March data.
It could create some real challenges for the economy.
The central banks are in a tough spot.
They need to continue to focus, very closely on the data as it evolves.
I am concerned about the fiscal outlook.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action and scores look like this. Negative 0.4 on the S&P following the biggest one-day sell-off so far this month on the S&P 500. We sit here now at the lowest level since early September. Coming into Friday morning, the losses continue, down by 0.6 on the Nasdaq, and in the bond market, unlocking higher yields on 2s, 10s, 30s. New highs for the year, 446 right now on 10s. And in the commodity market, crude drifting higher. It persists, and it's persistence that we need to talk about. Brent crude at 111, WTI at 97. The president saying this: please let this statement serve to represent that I am pausing the period of energy plant disruption by 10 days to Monday. This market is not celebrating the removal of near-term escalation risk. This market is wrestling with the extension of uncertainty to Monday, April 6th, 2026.
This isn't a market that can embrace a taco trade, the so-called Trump always chickens out and he can reverse course, partly because he can't. This is a now multi-party conflict that's dealing with physical assets being shipped. It is the Strait of Hormuz, this key waterway, and a question of who's going to ultimately control this. And frankly, his discussion is coming, given the reporting that we have right now, with tens of thousands of troops lining up to potentially make their way. This raises a question of what it's going to take to de-escalate and whether the persistence has already gone on long enough to create some real damage.
That's a key point. 2 Marine Expeditionary Units are already en route. And then on top of that, we have the 82nd Airborne Division that has already been deployed. And then on top of that, the Wall Street Journal this morning talking about the fact that the DOD is weighing whether or not to send 10,000 additional ground troops. So while the market is digesting the fact that this might be prolonged and the president's kicking the can in terms of these talks, at the same time, there's reporting that there is serious concern and discussions about the decision being finally made that this is actually going to escalate in a serious manner with more personnel on the ground.
Kicking the can does not provide relief anymore. Kicking the can for a market looking for a resolution is not going to provide comfort. When you kick the can, you're guaranteeing the strait will remain closed. You're almost guaranteeing that crude will hover around triple digits. And that's the additional scenario we're talking about throughout the program so far. We've been going back and forth on this. We've been talking about the two-way risk. It's resolved. Talks are a success. Or escalation. Things get a whole lot worse and you start hitting energy plants across the country. They retaliate across the Gulf. There's a middle ground. This just continues, lingers. The strait remains closed. You hold on to triple digits in crude, and that causes its own problems.
It's not exactly a growth shock to the same degree that, say, $150 a barrel would be for the United States. It's not an all clear as going back to $65 would be. As Russ Koesterich of BlackRock said, and I think it was a really good point, nothing is working in this backdrop. There is no haven trade. It is not gold. It is not bonds. It is not stocks. It is not even, as we saw yesterday, some of the tech stocks. So what does an investor do with what looks increasingly like a stagflationary type of backdrop?
And Tehran did not take that Truth Social post as a moment to maybe have a reach out through the Pakistanis and say, yeah, you know what, we will come to the table. This has been challenging for us. Our entire top level brass of individuals governing this regime have been taken out and targeted. Nope. What do you have today? You have missiles over Riyadh. You have the strait effectively once again closed. IRG starting back 3 container vessels in Hormuz this morning. They even made an abrupt U-turn. Chinese vessels made an abrupt U-turn, wasn't able to get through safely. At this point, Tanker Tracker says that at this rate, only 2 tankers a day on average go through the Strait of Hormuz. Far cry from the more than 100 a day we saw before this war.
Yeah, and these headlines from the Israeli defense minister from moments ago aren't going to help things. They're pledging to escalate and expand the attacks on Iran, saying the escalation would be in response to Iran targeting civilians. That's the escalation we're looking for. And as you've reminded us repeatedly, this is not just a war between Iran and the United States. There's other actors involved here as well.
It's Israel. It's the UAE, which came out with an op-ed in the Wall Street Journal saying, hey, this is getting really annoying to us. We want to offer some deterrence. You're getting Saudi Arabia involved, too. This is a much more complicated backdrop.
Futures near session lows on the equity market on the S&P 500, negative here by 0.5%. Coming up on the program, we'll catch up with Bob Michele of JPMorgan Asset Management. With crude holding on to triple digits, the ECB Governing Council member Pierre Wunsch joins us on the potential for rate hikes, and Sonal Desai of Franklin Templeton with the bond market on very shaky ground. We begin this hour with the bond market struggling as crude hovers near 110. Bob Michele of JPMorgan Asset Management writing central banks are all in a terrible position. Overall, the bond market continues to struggle to manage this inflation shock, and it's testing reaction functions. Bob joins us now for more. Bob, good morning.
Yeah, happy to be here.
Good to see you, buddy. And first of all, congratulations, Mr. $1 trillion man.
Yeah, thank you.
$1 trillion in AUM, and I know what a team effort.
Fixed income business is doing well.
That has been. Fixed income itself is not doing well.
Not today.
So let's talk about that. What's behind the shakiness and the fragility in fixed income?
Well, I think there are a couple things. I think, first of all, you're right. The bond market is pricing in the worst of all scenarios, which is the administration is desperately looking for an off-ramp, and there is none available. They're not going to cede sovereignty and control of the Strait of Hormuz to Iran. So if Iran doesn't give them a palatable off-ramp, then escalation is the only path forward. I think the second thing that the bond market is dealing with is we came out of the FOMC meeting a week and a half ago with the FOMC more concerned about the labor market than inflation. They had rate cuts still priced in for this year and next year. They were willing to look through it. And now you're hearing more hawkish tones coming out of the FOMC, particularly from Waller, who's right. It's not just about energy. You have to think about fertilizers, the planting season in the U.S. and across the world, and could that ultimately pass through to finished goods and prices?
We've caught up with your team a few times over the past few weeks, Kay, Priya, Kelsey. They've all said something similar, that we're unlocking value here in bonds, that yields are higher, that this should introduce demand. But we haven't seen that at auctions this week, and I think people have found that surprising. 2-year, 5-year, 7-year auctions, soft. Why do you think that is? Who's not turning up to these auctions that would typically turn up and buy these bonds?
Because things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. Just stand out of the way. Keep positions that you're comfortable with riding through this. Let the market wash itself out. That's always been the best thing to do. And if it's at levels that you want to add to positions, then sure, go ahead and lengthen duration, add to a bit of credit. Right now, we're still not expecting recession. You have to go well north of $120 a barrel for a recession. So in the meantime, just let the markets go to wherever they're going.
Is it a trade, though, or is it a technical issue? With a question about some of the central banks, whether in Japan, whether in the Middle East, that are needing to raise money right now to support fiscal efforts, that need to do things like sell gold, as we've seen. Is that part of what's behind some of these auctions that have gotten somewhat messy?
I think it's a technical washing out of positions right now, that everyone got crowded into a few trades. The central banks would eventually be cutting rates. All you have to do is actually look at gold. This is the absolute ideal environment for gold. It's the safe haven, it's the risk off, and it's the inflation hedge. All of those things should have pushed gold up from, call it 5,000 to 6,000 if it were fairly priced. It was an overcrowded trade. There's exiting from overcrowded trades. You talked about the lack of a safe haven. There is one. It's Treasury bills.
Treasury bills, but not long duration. And this is, I find, very interesting, given the fact that a lot of people are saying that this is a Fed that's going to be more hawkish. The implication should be, if you have belief in the Federal Reserve, that should lower inflation over time. That should reduce growth over time. That should reduce your appetite for longer-term bonds. Why is it not working that way this time?
Well, it is working because if you look at forward curves, the 1-year forward or the 5-year forward, actually, those yields have come down a little bit. So as more hawkish rhetoric has come out of the Federal Reserve, long-term inflation expectations are a bit more anchored than they were a week or so ago.
Inflation expectations, but not the bond yields. That's what I'm talking about. I mean, is this sort of the fiscal response?
There is the painful path from here to there. The hawkish expectations lead to higher rates, which then dampen aggregate final demand a bit more, and that ultimately cools off.
Bob, you're talking about the recessionary level of oil around $120 a barrel. That's where the physical market is, well above that. At some point, Brent will potentially, if this is protracted, catch up. The futures market will catch up to that physical market. And that might be sooner than people expect. What happens then?
Well, the data we're going to see over the next couple weeks is going to give us a lot of information, particularly next week when we look at the labor market data, because it won't fully have the conflict priced into it. It will still be somewhat clean. And if it's softer, it's telling you that actually the labor market wasn't on firm footing heading into all of this. If you're a business and you're already struggling with trying to understand what tariffs you're going to pay, what the impact of AI is to your labor force, and you've paused hiring, now you have higher input costs and you're concerned about demand destruction. Are you really going to go ahead and do some hiring? Our expectation is it's already starting to bite in the real economy.
This all sounds super gloomy. Should we finish with some optimism?
Sure.
Torsten Slok of Apollo just published. Check this out. Markets are overreacting to what will likely be a 4 to 6 week period of volatility, which will ultimately result in 50 years of stability in oil markets, supply chains, and geopolitics. Torsten, just moments ago.
Yeah, the headline of this is sentiment destruction, not demand destruction. Always watch what they do, not what they say, given the fact that people are feeling so nervous since they have to go out and shop to make themselves feel better and travel a lot more. He talked about how this shock is not enough to eliminate the tailwinds to the U.S. economy, and that is the reason why so many people have said, actually, the U.S. turns out to be more of a haven right now in all of its assets because of that tailwind, because of its ability to still grow.
The tailwinds being AI spending, the industrial renaissance, and the one big, beautiful bill. Bob, can you envision a better world 12 months out? Looking back 12 months out, and just seeing this as a 4 to 6 week period of volatility?
I can see us getting beyond this at some point. We keep going back to 20% of oil passes through the Strait of Hormuz. Why didn't oil go from $60 to $72 a barrel? So Torsten's right. There's some emotion in this. Whether it's troops on the ground or there's some sort of peace accord, we'll eventually get to the other side of this. I don't know that I want to look out a year, but I'll look out into the midterm elections. I think no holds will be barred into the midterm elections. And what is that, 8 months away?
What do you mean by that, Bob?
Well,
I think is going to happen?
Yeah, sure. I think when you look at the administration, they have to do whatever is possible to ensure that unemployment stays low. They've got to go back to affordability issues, particularly housing. You've got a new Fed chair sitting. You do have the tailwinds of the One Big Beautiful Bill Act. You do have all the CapEx because AI is real. Businesses know that. So you don't want to get too gloomy in here. That's why I said you just want to stay out of the way of this, see where it washes out. I think it's more technical than anything right now. Our bias is to add when we reach firmer footing.
It certainly feels painful right now with the 10-year at 446 and up another 5 basis points on the session. Bob, good to see you. And congrats once again. Thanks for being here. Bob Michael there of JPMorgan Asset Management on a very shaky bond market through the week so far.
Yeah, and he's talking about how it's a technical washout and that longer-term bonds are the haven. He talked about T-bills, not necessarily longer out the yield curve, not now anyway. Michael Hordern, I keep going back to this, expecting policy panic to support the economy heading into those midterms. I just wonder how much that's part of the reason why people don't want to go long bonds right now, if there's policy panic that comes in to flood the market.
If Bob's coming on the program and advocating for T-bills, you know it's a stressful moment, right? Certainly a stressful moment.
You know, you're also getting good yield, so I could understand it, and you are seeing some inflows into that area.
Let's get you an update on news elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump pushing back his deadline for a deal with Iran, saying he will pause attacks on the country's energy sites for 10 days. Trump also saying talks with Tehran are going, quote, very well. Iran says it's waiting on a response from the U.S. after rejecting its peace plan and offering its own conditions to end the war. Israel not planning to wind down its military strategy against Iran. Defense Minister Israel Katz saying moments ago attacks will escalate and expand to additional targets and areas important to the regime. Katz saying he and Prime Minister Benjamin Netanyahu had warned Iran against attacking civilians, but the firing has continued. And here's another jab. JPMorgan is planning a new private credit fund that will allow investors to redeem 7.5% per quarter. According to the prospectus, the fund will invest at least 80% in credit, including a substantial portion in private credit as well as publicly traded loans. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, making time for a deal.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to. All I can tell you is they're begging to make a deal.
We'll talk about that next with Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. The self-imposed deadline has been extended. Diplomatic efforts continue between the US and Iran, we're told. That continues, and this continues too. Equity futures on the S&P 500 pulling back by 0.5%, on the Nasdaq down by 0.6%, adding to some big losses yesterday, the biggest one-day loss we've seen so far this month. The S&P 500 closing yesterday at the lowest we've seen since early September. In the bond market, that risk aversion unlocking higher yields, not lower yields. The source of the disruption in the bond market, around 4% on twos, 446 on tens, pushed higher by this move in crude. The move persists, triple digits. Brent crude, 111. WTI, 97.
And you've heard a slew of central bankers come out and say they are worried about inflation. They have to be vigilant, and they have to get inflation back down to 2%, given that it has been more than 5 years since we've hit that target. We're repricing a Fed response function. We're repricing the ECB.
It's a lot of uncertainty hanging over this market through to at least, potentially, April 6th. Under surveillance this morning, making time for a deal.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to, but they're doing it a little bit. I don't look. Their capability is a lot less than it was 2 weeks ago, and with every week and every day, frankly, it gets less and less. All I can tell you is they're begging to make a deal. So let's see what happens.
The President of the United States extending talks with Iran for 10 more days. The President saying talks with Tehran are going very well. Jonathan Tamari of Bloomberg Government joins us now for more. Jonathan, welcome to the programme. We're tracking two things. One, the talks, the status of them, and two, troop movement. Jonathan, what do we know about both this morning?
Yeah, the state of the talks, it depends on what you're listening to publicly, privately. Publicly, you know, Iran says that there's not progress. The president says there is, that they're desperate to make a deal. Obviously, both sides are posturing there. And yes, there are reports that there are additional troops now moving into the region. And there's a lot of concern within Congress, I would say, about what that means, given that Congress has had really no say on this fight so far. And the addition of ground troops would be a significant red line, I think, for a lot of members of Congress, including some Republicans.
Do you think they're in a position to stop it?
Not right now. And in fact, they're about to be away for 2 weeks. And there's a concern among some lawmakers that while they're away on a scheduled recess, the president could escalate things and Congress would really be in no position physically to take action.
The calendar is not friendly to risk assets right now. Bloomberg's Jonathan Tamari there with the latest on the situation following two tracks, the status of talks and the status of troop movements.
Yeah, and people are watching those troop movements very closely. We talked earlier about that Wall Street Journal report. Congress, you think that they're going to actually step in here? They haven't even been able to make a move on TSA. I mean, that was superseded also by President
They're not
Trump.
there, even when they are there.
They're correct. Thank
Right?
you. Even the vote last night, it was basically empty last night in the chamber when they voted at 3 a.m.
Yes, and it was just basically, yay, let's get the show on the road and let's make sure TSA is funded. That exchange I had yesterday with the president, he said that their capabilities have been decimated, but it hasn't changed the facts on the ground for the Strait of Hormuz. Every single day, according to tanker trackers, we're just at 2 vessels getting through on average since this war started, and tomorrow will mark 1 month. Before the war, it was more than 100, which is why the physical market is so much higher than what we're seeing in the paper market.
We've seen the damage done to some of the energy assets in the region. It's going to take time to repair them. And we know that when you shut in production, the longer you shut in production, the longer it takes to ramp it up at the other side. So we know this is going to go on for another 10 days and the market is responding to that lingering uncertainty. Tobin Marcus of Wolfe Research writing this: we don't think either side has reached the limits of its pain tolerance. The president thinks the US is winning and the Iranian regime thinks they're winning too. Tobin joins us now for more. Tobin, where does that leave us?
I think it leaves us in largely the same dynamic that we've been in, where the president faces, options to escalate, to try to de-escalate, which he's doing now, or just to stay the course. I think all of those have downsides from the U.S. perspective. And I think anything other than, a surprising diplomatic breakthrough that we don't expect is going to perpetuate and intensify stress on markets.
Tobin, the Wall Street Journal also has that Iran, this requested 10-day pause on strikes, was not coming from Iran. Iran never requested this the way the president presented it to the world. What do you make of that? Is the president negotiating with himself? Is he just buying time as he has this troop buildup?
Yeah, what we were saying prior to the announcement of this extension earlier yesterday was if we do see an extension, which seems like a very real possibility as we were approaching the end of that 5-day period, which the president himself speculated about the possibility of an extension during the cabinet meeting yesterday, that if that were to happen, it would reflect basically that the U.S. wasn't ready to choose between to decide whether or not to undertake one of these decisive escalation options rather than representing real, progress behind the scenes. And so I think characterizing it as having been demanded by the Iranians, even when the reporting contradicts that, largely lines up with that theory. So, maybe it's a very specific smokescreen for planned escalation, and he's waiting for more assets to get into the region. There's been lots of commentary about the first Marine Expeditionary Unit scheduled to arrive today, but there's more on the way. There's airborne troops on the way. So we could still be positioning for a definitive escalation plan, or he could just be buying time. If he's not ready to pull the trigger on either strikes on electrical infrastructure or one of these mooted ground operations, then, you can always kick the can down the road.
You have a new tongue-in-cheek alternative to taco, and you say it's a kebab. Kinetic escalation before abruptly backing off. What kind of kinetic escalation could we see?
I think the kinetic escalation that we had in mind when we came up with that kebab idea was what we've already seen, right? That we undertook this war. It's been, very high intensity so far. And then at some point, chickening out, I don't think is a great characterization of anything that's gone on here, but that at some point you could see the president try to just de-escalate. Notably, as people talk about, taco and the strike price of the Trump put and so forth, the one thing we haven't actually seen him do is make any actual move to de-escalate. We've seen him, open talks. We've seen him talk about talks, but those are all an idea that he might de-escalate if we see big concessions from the Iranians that there's been no indication that they're willing to make. What he hasn't done is actually reduce the intensity of U.S. strikes, actually, undertake a unilateral ceasefire and see if the Iranians respond in kind. And so I think, going back to the comments earlier about whether or not the two sides are at the limit of their pain tolerance, if we actually start to see the president in more of a panic about the market and economic and political backlash, which I don't think he's in right now, that option is still available of actually trying to de-escalate, short of, telling the Iranians essentially that we're ready to accept their unconditional surrender, which has been the U.S. message so far. And I don't think that surrender is in the offing.
Tobin, if this continues for weeks and possibly even months, how big is the blue wave going to be come November?
So I think the kind of elasticity of political outcomes to how this goes is relatively low. The House, I think, is basically, a foregone conclusion to flip Democratic, and we've thought that for quite some time. The Senate, betting markets are now starting to believe in a blue Senate. I personally don't really. I think it's a real long shot for them in these 4 red states that they would need to win 2 of: Alaska, Iowa, Ohio, and Texas. Those are all big reaches. And so I think we're in a universe where, even as the political situation deteriorates, as the war continues, as gas prices go up and so forth, there's not that many more seats you can lose in the House based on the way the maps are drawn, and similarly in the Senate. So if I'm President Trump, and I suspect that there are people around him telling him this, if the House is lost, the Senate's not that losable, that does give him room to have the courage of his convictions. If he thinks that this is a generational problem that he can, either substantively or as a way to kind of enshrine himself in the pantheon of American presidents by dealing with this, I do think that has some appeal looking past the midterms.
Tobin, it's good to see you. Thanks for catching up with us. Tobin Marcus there of Wolfe Research on the sentiment shock. You, Mitch, consumer sentiment coming a little bit later on this morning. Look out for that number. Might not be pretty. Up next, ECB Governing Council member Pierre Wunsch on Europe's path forward. Equities declining here near session lows. We're down by 0.4% on the S&P, on the Nasdaq negative 0.6. The losses yesterday notable, the biggest one-day loss we've seen since this war started. But one thing that hasn't been talked about enough, it's not just about the Middle East. There's something else happening here. It's also about tech and tech names. Microsoft having a really difficult go of it, down by 30% from the highs of last year. Meta down 15% this month, hammered yesterday. The Nasdaq 100 basically in correction territory.
It's down about 10% from its recent highs, but the idea that it hasn't seen a new high going back to 2025 gives you a sense of just how far we've fallen. They've lost their leadership. What does it mean at a time when we talk to a lot of investment managers saying that big tech is the haven, that we are not seeing that actually play out at a time of stress?
We've thrown so much of this market, tech problems, the Middle East, private credit, and bond yields just squeeze higher, making everything worse. Tighter financial conditions, yields up by 4 basis points, 4.45 on 10s, 2s around 4%. The president removing near-term escalation risk, but introducing longer-term uncertainty with 10 days of talks.
Especially because oil prices still are around that $100 a barrel, presenting a quagmire for central bankers. Do they hike rates? Do they keep rates where they are for a prolonged period of time, even as you do get some demand destruction? And you talk about how you do have financial conditions tightening. They're not tightening very quickly, but around the margins, just steadily increasing, with mortgage rates hitting their highest levels so far this year.
Going into spring salad season, which isn't welcome news for a lot of you working in the housing market, I'm sure, and if you're looking to sell your home or buy a home, of course. In the commodity market right now, Brent crude, Brent 110, WTI 96. It's the persistence of this story that is going to cause problems, that the Strait of Hormuz remains closed.
Absolutely. And there's a note from Macquarie today that if this goes on till June, which at this moment, potentially you could see the strait not being operational in the normal way. This can go on till June. You're looking at $200 a barrel. Caught my attention this morning, Qatar Energy. Force majeure for liftings through May. This is liquefied natural gas that the world is really relying on, especially Europe and Asia.
Stocks are softer this morning. We're negative 0.4% with some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. AstraZeneca this morning up 3.6%, releasing the results for a treatment of a deadly lung disease. That result showed that it was able to target improvement for the deadly lung disease. Bloomberg Intelligence saying that this would be a $5 billion addressable market for AstraZeneca. So shares, again, rising in the pre-market. You mentioned the tech, you mentioned the big cap, but it's also software, which continues to get hammered. The blame was originally put on that Google announcement of compressing the need for memory, but the pain has really continued. SanDisk and Western Digital and Micron all down at least 2.3%. SanDisk is down 15% in this week alone. It's also up 1,000% over the past year. So some of those gains coming off. Now, finally, wrapping things up with some deal news. Brown-Forman, those shares moving unchanged at the moment. This is the maker of Jack Daniels. They announced it as a merger of equals, which tends never to actually be the truth. But with them and Pernod Ricard, they're both heavily family-owned businesses. According to people familiar, this deal would involve a lot of stock. So those owners can keep control. So Brown-Forman, one to keep an eye on, but unchanged at the moment, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, President Trump announcing an executive order bypassing Congress to pay TSA agents during the partial government shutdown. This morning, the Senate approving a bill funding most of DHS. A House vote is expected later on today. Elsewhere, the president extending his deadline for striking Iranian energy sites for 10 days. Trump writing in a post on Truth Social, talks are going, quote, very well, even though Tehran insists it's not negotiating with Washington. And finally, the Secretary of State Marco Rubio calling on NATO allies to step up and do more to help secure the Strait of Hormuz.
There was a couple of the leaders in Europe who said that this was not Europe's war. Well, Ukraine is not America's war, and yet we've contributed more to that fight than any other country in the world. Very little of our energy comes through the Straits of Hormuz. It's the world that has a great interest in that, and so they should step up and deal with it. They should be doing something about it.
The Secretary, Marco Rubio, meeting with G7 foreign ministers in France today.
A polarizing message right now. And you hear, for example, UK Prime Minister Keir Starmer saying he's only going to harden his stance against joining this in any capacity or even opening up certain regions to U.S. troops as a result of pushback. Mark Rutte, the head of NATO, facing huge pushback among some of the other nations after going on CBS's Face the Nation over the weekend and saying Trump is doing this to make the whole world safe, saying what the president is doing here, which is taking out, degrading Iran's capability to be, again, an exporter of chaos, sheer chaos to the region, to the world, saying this is a fight that NATO should join.
I think two things can be true at once. Raj's right. The Iranian regime is the biggest state sponsor of terror, and it doesn't help anyone in this world if they were to get a nuclear weapon. At the same time, I think the Europeans might be even emboldened by what J.D. Vance said last year. I can't get over this. J.D. Vance gave an interview, the vice president, and said the Europeans, maybe if they were a little bit more independent, if they weren't just a vassal of United States foreign policy, maybe they would have stuck up instead of going into the Iraq war with the United States, which J.D. Vance called a strategic disaster, the American-led invasion of Iraq. So you can have some capitals in Europe not really getting on board with wanting to a more protracted environment and maybe getting engulfed in this sort of conflict. And that was his message just a year ago.
We've seen that pushback this month alone. Let's talk about Europe. Global central banks facing the threat of higher inflation as energy prices soar. The ECB navigating mixed signals with some policymakers ready to act fast, others urging caution. Joining us now to discuss is an ECB Governing Council member and the National Bank of Belgium Governor, Pierre Wunsch. Governor, welcome to the programme, sir. Let's just start with the nature of this shock. From your perspective, is this the kind of shock that a central bank should look through?
Well, that's, of course, the big question, and we know the textbook case is for looking through for if you're confronted with a supply shock. Now, in the meantime, we have the episode of 22, and in 22 we were a little bit late in reacting. We had team transitory. We're not alone. I was maybe one of the first governors to be concerned about the fact that inflation might go up further than what we had in our models. So now we are there. We have, again, a supply shock, and we have to decide how to react to it. We should not overreact. I think so far we were able, I think, to communicate the fact that we would react if need be, but that we were not going to rush to do anything that would be looking like overreaction. But anyway, I mean, we have to. 22 is different. We have the textbook, and we need to find a middle way between what we have in the textbook, which is we don't react, and the experience we had in 22. But in 22, of course, there were a lot of bottlenecks in the system, very tight labor markets. You had a lot of fiscal support coming out of the COVID crisis, and that's not the situation we're in today. The labor market is a bit weaker in Europe. So we will have to find a good balance between the textbook situation and, again, what we experienced 22.
Governor, does that give you more time? Does that give you more time? And is April too soon to know what kind of shock this is to understand if you should look through it or react to it?
Well, if the conflict is mainly over by April, then I guess we will be closer to what we have in our baseline. We had just made some projections during the last meeting of the Governing Council. I think the base case that we produced was still relatively benign. Inflation was moving to a peak of 3%, but not on a yearly basis, and then going down quite quickly to 2%. On the basis of that, it's not clear that a reaction would be warranted. Of course, we were doing the projection on the basis of 2 hikes that were priced by the market. But I would say, if we are still close to the baseline, that it's not clear we have to react. If we move to what we call the adverse or the severe scenario, then we have higher inflation and certainly more persistent in the case of the severe. And then my guess would be that we would have to do something. But even then, I think we need to make a distinction between reacting so that real rates remain stable or reacting and increasing real rates. So if you believe that core inflation is going to go up for a period over a year, you may want to react, and the first hike might just be adjusting to this higher core inflation. And then there is a stage if the shock is bigger and you have significant second round effects, which is, of course, a big part of the uncertainty, where you might have to tighten as such. And I would still make this difference. Hiking as such, if core inflation is going up, might not be tightening. And I'm not talking about, spot real rates, but say over a period of 1 or 2 years, depending on what our view of the world is.
Governor, it sounds like you're more patient potentially than some other members on the ECB. I'm thinking, for example, of a recent interview that ECB President Christine Lagarde did with The Economist yesterday, saying that the ECB would have to respond in a forceful or persistent way if inflation looked set to sit well above its 2% target for an extended period. Most people would agree. But she said even a more modest overshoot could call for a measured rate move. Do you agree with that? That if inflation does not look like it is poised to go down to 2%, say, by the end of this year, that it makes sense to signal to markets that you're serious about containing inflation by making a hike?
Well, if I gave the impression that was not aligned with Christine Lagarde, I'm sorry for that, because we are completely aligned, or I'm aligned to her. With her view, but I was just discussing the case where by the meeting of April the conflict would be over. And then, honestly, it's still something that is probably relatively benign, and we might have to react or not. But that's not, a difficult situation probably to deal with. My concern is, of course, and the concern of many people and of the market, is that it would not be over by April, or maybe not even over by June. What I would like to have is a better mapping of the scenarios that we are making to actually the conflict lasting until April or until June, that we have a better mapping of our scenarios and basically the meetings of the Governing Council. But it's moving fast. So one meeting is April, another meeting is June. If the conflict is not over by June, then we are, most probably way above our baseline, and that would probably warrant some kind of reaction.
Governor, do you think that the ECB is hamstrung by the fact that it is a single mandate Fed dealing with an inflationary shock that the Fed looks like it's currently prepared to look through, given that there is a serious growth hit on the other side that is potentially going to transpire?
Well, in a way, it makes it easier, because if you have only one objective, you only look at one target. But we always insist that we have an objective over a medium-term horizon. So we do integrate the impact of the shock on growth, and to the extent that the impact of the shock on growth would be to some extent deflationary. I don't think that's the base case, but of course we would have to take that into account. But it's taking into account the impact of the shock on the real economy, and then the repercussion in terms of whether we're going to be faced with second round effects or not. If the economy weakens fast, then the second round effects might be limited, which might warrant less of a move. And the big uncertainty is, of course, the labor market and the economy is less tight than it was in 22 coming out of the COVID crisis, with all these bottlenecks in the system. But economic agents were surprised by the pickup in inflation. We had known a period of low inflation for a very long time. So people reacted, as much as we did in a way, slowly to the inflation developments. The big thing now we have to monitor is whether economic agents, firms, and then workers will adapt more quickly this time to the shock. If this is the case, it might lead to second round effects that will be quote unquote higher ceteris paribus compared to the level of the shock. If because of weaknesses in the economy and the labor market, firms and then workers don't react fast and basically take the hit, then the case for reacting is less strong.
Governor, just a final question. Listening to you to recap, what I hear is patience. The prospect of two different scenarios with different responses. What I see in markets, though, is tighter financial conditions, a market doing the work for you already. Higher yields on government bonds, pricing in the prospect of rate hikes from the central bank over the next year or so. When you look at that, do you consider that an unwarranted tightening of financial conditions, given the patience that you've pledged this morning already?
Well, I'm patient today, but in April, if we're still there, I might not be patient. So I don't want to convey the message that we are not ready to act. But I'm comfortable with what I see in the market. But given the uncertainty is huge. So, making any judgment today on what we can do in April or June, given the uncertainty, the market signals or reaction will be different next week and the week after next. We have to monitor that. We have to at least, we should not overreact. We are not going to control the first round effects of this shock. So we should not even try to control the first round effects. So in this sense, we have we have time to react adequately, depending on what is our perception of what the second round's effects will be. But, April is not out of the question. If by April we have solid evidence that the shock will be lasting and will lead to a big hike in inflation that is likely to have some degree of persistence, then we might have to do something. But, we still have some time before the April meeting, and I don't want to take any bet in one or the other direction.
We are all flying blind, sir. We appreciate your time. Governor, thank you. The Belgian Central Bank Governor there, Pierre Wunsch, on the situation in European debt markets and in European rates.
Stephen Englander over at Societe Generale, Standard Chartered, came up with this line in a recent paper. FOMC Powell likely to aggressively do nothing. And it seems like right now ECB officials want to aggressively not take a position because they don't want to give a signal that could potentially be committal at a time of so much uncertainty.
They want to commit to anchoring inflation expectations, but they don't really want to be hiking interest rates here. That's the delicate dance for communication into the next round of meetings.
Given the lack of growth in terms of the backdrop and the potential hit to inflation longer term, it's a difficult time for them, and you can hear that.
Let's give you an update on news worldwide with some top stories. Your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. The Senate's passing a bill to end the Department of Homeland Security shutdown. The bill still needs to pass the House and be signed by President Donald Trump. Before the bill was passed in the Senate, the president had said he would sign an order to pay TSA officers. A legal victory for Anthropic, the maker of the chatbot Claude, winning a court order blocking a Trump administration ban on government use of its AI technology. Anthropic argues the ban could cost it billions in lost revenue. And Apple giving rare bonuses to iPhone hardware designers. Sources telling us here at Bloomberg the company gave bonuses worth several $100,000 to many members of its iPhone design team. The company is hoping to stem a wave of departures to startups like OpenAI. That's your Bloomberg brief. John.
Yahira, thank you. More from Yahira in the next hour. Up next on the program, keeping the pressure on the Fed.
We have a great new person coming in to take over the Fed. Kevin may not ever have an office, but they don't sue the guy whose interest rates are too high. We call him Jerome Too Late Powell.
We'll spend some time on that in just a moment. Sonal Desai of Franklin Templeton joins us next. So we're recovering just a touch. We're off the lows. We're negative by a third of 1% on the S&P. We're down 0.5 on the Nasdaq. On the Russell, we're down 0.4. In the bond market, shaky. Yields bleeding a little bit higher at the long end of the curve, 10s around the highs of the year. Under surveillance this morning, keeping the pressure on the Fed.
We have a great new person coming in to take over the Fed. And Kevin may not ever have an office, but they don't sue the guy whose interest rates are too high. We call him Jerome Too Late Powell. Janine Pirro, working with Pam and others, has the courage to sue to find out what happened to maybe $4 billion and a building that may never be occupied by Kevin. We're gonna have to find him some space in the White House. We'll put him in the basement of the ballroom.
So here's the latest this morning. The president continuing his push for lower interest rates as the confirmation of Fed Chair nominee Kevin Warsh remains on pause. Sonal Desai of Franklin Templeton writing, even before the current shock, I was not expecting any more cuts, but it is too early to forecast rate hikes. Sonal joins us now for more. Sonal, welcome to the program. I know so many people in fixed income itching to get long duration because yields have backed up, but they're nervous. What are you advocating for?
So, we came in, thanks for having me on, Jonathan, but we came into this year actually a little bit short, and we are moving slowly towards neutral, but I am not tempted to go long yet. This is essentially, when we talk about the two, it's either a bimodal distribution or more accurately, there are two tail risks, and we certainly can't predict which of those tail risks comes to fruition if either one of them, i.e. a very protracted conflict or a very short conflict. You can't actually position your portfolio to either one of those two tail risks.
Sonal, forgive me, I keep harping on this one topic. Why are long-end bond yields rising right now? And I look at inflation expectations in the break-even rates market. Long-term inflation is not ticking up. If anything, it's going down. This is a real rate move at a time when people are looking out to the potential of a decline in growth. Can you explain what's going on currently in the long end of the yield curve?
To me, actually, what the market is doing is really rational. It is anticipating that, yes, there may well be a decline in growth, and the response to that decline in growth is going to be massive fiscal easing. You know, your prior guest from the ECB, he only spoke about monetary policy. He didn't mention what the probable fiscal response would be if this were to be a protracted conflict. There isn't a government in the developed world which will probably not react by trying to accommodate some of that weakening through a greater fiscal push. So I think that bond markets are actually behaving pretty rationally right now.
Do we think that we're pushing up against the limits of using a fiscal lever to offset weakness based on the pushback that we're seeing right now from the bond market?
So it depends. Well, wasn't that? That's a useful statement. I don't think we're getting to a limit, okay? Because here's the thing: there is an enormous amount of liquidity floating around globally. There is the ability to finance more bonds. However, at this point, clearly the market is not accepting that the yield is an adequate compensation for the prospect of higher inflation and higher bond supply. But you do find a market clearing point. So how much can fiscal do? Even automatic stabilizers by themselves will lead to widening fiscal deficits. So, you know, the fact that unemployment goes up, so unemployment benefits go up. And so you will have a widening in the event of a significant slowdown. And I think there's a big difference between what's happening in Europe, as I think you've mentioned yourself, versus what's happening in the US. But in the US, for a whole host of other reasons, we're looking at fiscal profligacy as we've never seen before. For the last 5 years, we've seen it, and I see no indications that this is going to go away anytime soon.
So now, what you just said there on fiscal, I think is really important for multiple reasons. Here's one. Do you think it increases the odds that we'll see second-order effects if governments step in and try and support consumers in this moment?
Oh, in terms of inflation?
Yeah.
Yeah, because actually it was the opposite way around. If you think back to the famous transitory period of 2021, what was really going on in 2021? We did have very easy monetary policy, but the reality is we had an enormous fiscal splurge in the first quarter of 2021 as a new administration came in. It was absolutely enormous. And so back at that time, to me, it appeared absolutely self-evident that you were going to get demand push inflation, which the Fed kept saying was a supply side impact. And eventually, of course, we got the results we got. If you do get that fiscal accommodation of a shock of this nature, you will get second-round effects. Ultimately, let's take an extreme scenario. Let's suppose that we really are hitting and taking out not just 20%, but oil facilities, say, in other parts of the Gulf, which is responsible for 30% of global oil supply. Supposing you actually do something much more terrible, which leads to a several-year contraction, you can't accommodate it because ultimately you need demand destruction, which translates into slower growth. And if they try to not do that, that's a problem.
Sonal, appreciate your time. Thank you. Sonal Desai there, Franklin Templeton. Of course, this shock is hitting just as tax refunds are hitting as well.
That's the tailwind that Torsten Slok is talking about that will leave us in a bullish place at the end of the year.
Up next, Mahajan of Edward Jones, Kylie Cohu of Jefferies, Michael Gapen of Morgan Stanley, Ajay Rajadhyaksha of Barclays. The third hour of Bloomberg Surveillance just around the corner.
We're at a world now where there's heightened uncertainty. If we have a peace deal, then we could have a relief rally in markets. The market has been volatile during this period, but not a tremendous amount of downside yet.
The market is pricing in that there's going to be a resolution.
We are going into an area of really uncharted waters at this point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. And your price action looks like this. Off session lows, but no bounce. The absence of a bounce here notable. Equity futures down by 1/3 on the S&P, on the Nasdaq down by 0.5. Negative follow through following the biggest one-day loss of March so far. In the bond market, yields 2s, 10s, 30s higher on 10s, up 5 basis points. A new high for the year. 446 is where things stand. Off the back of this, crude. The problems persist. Triple digits, 111 on Brent. 97 on WTI, with this statement from the President of the United States. Talks won't wrap up in the next 24 hours. You'll have another 10 days. New self-imposed deadline, April 6th. The market take, the problem persists.
Ultimately, as you've said many times, we don't have clarity. I would take this a step further. There is a real signal right now that's coming from the markets, which is that the power of truth social diplomacy is losing its clout. We are looking at a market that doesn't see any easy resolution to this, and it isn't one man's decision to ratchet the temperature down and solve things. That, I think, is the takeaway from this week.
These aren't paper problems that you can solve with verbal intervention. They are physical problems. Jeff Curry of Carlyle talked about it multiple times on this program. You cannot print the barrels. You cannot print the molecules. You cannot reopen the Strait of Hormuz through talks alone. If they continue, by definition, it is closed. That's the situation. And as that problem persists, the problems keep building.
I think you need to look at action in the region and not words. And what we've seen just this morning, action in the region, you're seeing missiles across Riyadh. You're seeing the IRGC not let vessels through the Strait of Hormuz. You're seeing Chinese vessels. China buys the lion's share of Iranian crude that was before the United States decided to unsanction some of it that's on the water. They had vessels going through and made an abrupt U-turn. The facts on the ground and the reporting that the president is even weighing potentially sending 10,000 more troops show that this is going to be longer and this might be protracted. And that is why the markets are starting to wake up, that you cannot, as you say, taco your way out of this.
We have replaced the threat of near-term escalation risk and introduced the persistence of long-term uncertainty, at least for the next 10 days or so. And we're tracking two things. One, not just the movement of talks and the diplomatic effort, but two, troop movement. This from the Wall Street Journal. The Pentagon looking to send up to 10,000 additional ground troops to the Middle East to give President Trump more military options, more uncertainty.
Let's go back to the conversation that we had with Colonel Sanders from Bloomberg Intelligence earlier this morning, where he said, this seems like a significant troop buildup, but when you compare it to the Gulf, you saw more than 600,000 troops deployed to that effort. That said, it indicates a potential ratcheting up, and it comes alongside the fact that the UAE and Saudi Arabia both are being vocal about, hey, you better not pull out now and leave this as the status quo, because you're giving Iran a lot of power over one of the main waterways of the world.
That's why this doesn't look to be a garrison. This doesn't look to be permanent troops on the ground. Strategic. Can they go in there, these individuals, highly trained to do things like this, to capture islands, to open up waterways? But can they go in there and fix this in a short amount of time? And the Iranian parliament is talking about, even if this becomes open in the future, there's now going to be a toll. They've effectively said, we have demonstrated we can control this strait, and we are not going to give up that leverage.
Brent crude this morning, right now, very close to 111. Coming up this hour, we'll catch up with Mona Mahajan of Edward Jones. With diplomatic uncertainty hanging over markets, Michael Gapen of Morgan Stanley still calling for 2 rate cuts this year, and Ajay Rajadhyaksha of Barclays on the widening cracks in the U.S. economy. We begin this hour with stocks adding to losses as traders brace for a protracted war. Mona Mahajan of Edward Jones writing, while market volatility may persist, this may also provide opportunity. We prefer U.S. large cap and mid-cap equities, emerging market equities and cyclical sectors, including industrials. Mona joins us now for more. Mona, welcome. We face what we've called all week substantial two-way risk, and that two-way risk will hang over this market now until at least April 6th, guided by the president's self-imposed new deadline. Mona, what are you advocating for between now and then?
Yeah, John, look, this has become a show-me story, and it's not only about updates on negotiations with Iran. It's really about what's happening in the Strait of Hormuz and what's happening with oil prices. And markets are almost indirectly correlated with the move in oil. We see higher oil prices this morning. We see lower futures, despite the 10-day pause or extension in the negotiation itself. So, generally, we are waiting to see what the duration of this conflict and especially of the elevated oil prices will look like. If you look at WTI futures markets, markets are still pricing in oil returning to mid-70 levels by year end. So if this conflict does remain contained, we think the spillover effects can remain contained as well. Now, there's a probability around that. That's a base case scenario, but there are tail risks on either side.
So, Mana, that's the story. Let's talk about the price of the story a little bit more. Equities on the S&P 500 down almost 6% so far this month. So far this month on a 10-year maturity, yields higher by some 50 basis points. Is the risk-reward right now more attractive in stocks or in bonds?
You know, we still see a compelling stock or equity story ahead. Look, this is still an environment where we think the economy is going to be positive this year. Economic growth, we still think, can hover in that 2% range. And importantly, the earnings story, we think, is still intact. And keep in mind, parts of earnings, think about the energy sector, will see some benefits from a rise in oil prices, although parts will not. Margin compression is a very real story there. But what's important in the U.S. is we have this underlying secular theme of AI technology and CapEx spending. And that, to us, will continue to be a driver. We think earnings growth can be high single digits, low double digits still for 2026, and that provides some underpinning to the stock market.
The tailwind comes from big tech, and yet we've seen big tech of late not outperform. It has lost its leadership through most of this year, and we've seen this sort of cyclical rotation into some consumer-facing names. Can that kind of trend persist, given a backdrop of higher oil prices and stickier Fed policy rates?
Yeah, you know, it's interesting. Certainly through the Iranian crisis, we did see a bit of a pause in that broadening cyclical story. And in fact, a return to maybe a little bit of what are considered defensive parts of the market. And technology and AI was part of that, partly because they had already seen a meaningful correction sell-off prior to the crisis, and maybe folks were looking for entry points again. But keep in mind, these are companies with tremendous balance sheets still, and can be considered relative safe havens in this environment of uncertainty. So we do think that the tech AI story is still part of a diversified basket for investors. And it does come to the forefront in times of uncertainty like this. And certainly, as we think of an environment where the US dollar is rising, there are winners and losers there as well. But overall, we think the diversification is going to be an important part of the 2026 story, unlike the last 3 years where it was very, very much about concentrated portfolios.
John was asking Mona this idea of what you like better, bonds or stocks here. You said stocks. At what point does the rise in bond yields pressure the stock story based on the fact that it's really come from real rates, and usually that does crimp potential for multiples?
Yeah, you know, look, we are looking at, we called for a 4.5% range on the 10-year Treasury. As we get perhaps above that, or if we do get above that, we would start to look at duration more meaningfully. You know, keep in mind, when we think about a Federal Reserve and what they might do going forward, we still don't see the potential for rate hikes on the horizon. We do think that this is a supply-driven shock. If oil was rising because demand was overheating, then yes, rate hikes could make sense. But very much this is, you know, supply shock, and a rate hike in this environment probably won't help that problem at all. So we think the Fed is on hold here, but we do think over time, and they indicated this still in the meeting last week, they are looking at 1 to 2 additional cuts in this cycle as well, which of course is broadly supportive. So we are looking at still, if bonds get above that 4.5% range, we consider that more interesting here.
Mona, though, if this is a protracted conflict, do you think the Fed would be able to cut interest rates?
You know, we certainly think in the scenario that this is, you know, the tail risk emerges and this is protracted, deep, prolonged, then we do start to think about a market that doesn't look as strong, that earnings growth does fall more meaningfully because consumers are pressured and corporate margins are pressured, especially those corporations that have energy needs. And in that environment, the Fed is likely to cut, but cut for the wrong reasons, which, you know, we don't want them cutting because they see an imminent downturn or recession in the economy. If we do see rate cuts, we'd like to see them because they want to neutralize the Fed funds rate a bit more, and they're too restrictive at this point. So, you know, in this scenario, historically, when we look at the Fed and what it means for markets, when the Fed is cutting because the economy is faltering, markets actually don't react as well. When the Fed is cutting because they're neutralizing, markets actually prefer that environment. We're hoping for the latter.
Mona, good to see you. It's good to catch up. Mona Mahajan there of Edward Jones. This is the communication dilemma for a central banker right now, whether they're in Europe or the United States. What they want to communicate and what they actually want to do, two different things. They know they have to pledge to anchor inflation expectations. And because of that, they can't invalidate market pricing, which is pricing interest rate hikes, particularly in a place like Europe. But they definitely do not want to be hiking into an energy shock right now or anytime soon. There is a real reluctance, and I think you can sense that from what you hear from some of these officials at the moment.
I mean, the ECB banker said absolutely nothing.
Without
I mean,
a doubt.
ultimately, you're going forward.
Brutal,
I mean, well, no,
yes.
but they're aggressively saying nothing, and that's on purpose. That's a policy decision, given the fact that ultimately, to your point, if you've got tightening financial conditions, that will crimp growth and potentially curtail the potential for inflation, both in real terms as well as in expectations.
We talked about it briefly earlier, and I'm looking forward to this conversation with Mike Gapen over at Morgan Stanley, because they've broken out 3 scenarios, not 2. And we've been talking about it around this table that essentially the market's focused on 2, the prospect of much higher crude prices or the prospect of much lower crude prices. But there's a middle ground. And the middle ground's more problematic for this Federal Reserve. And I think for any central banker, central bankers seem more comfortable at extremes because they know what to do and they can do it with confidence. If you get a major recession, you throw the kitchen sink at it. And I've always said I don't think that's particularly brave or impressive because you know exactly what you need to do. It's moments like these that are really difficult to understand, to know what to do. And Mike Gapen's work on that, we're going to touch on it later, is pretty interesting.
Especially because they did give a 3-pronged scenario, and they said that the one that presents itself to central bankers as giving the most reason to hike is the one that we're in right now.
The 110.
The 110 rate. That is actually this uncomfortable situation that could prompt a Fed or an ECB to raise interest rates.
That conversation just around the corner. Look out for that. Let's get you an update on news worldwide with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. President Donald Trump pushing back his deadline for a deal with Iran, saying he will pause attacks on the country's energy sites for 10 days. Trump also saying talks with Tehran are going, quote, very well, but Iran says it's waiting on a response from the U.S. after rejecting its peace plan and offering its own conditions to end the war. Israel saying it will step up strikes against Iran despite President Trump's delay. Defense Minister Israel Katz saying the attacks will escalate and expand to additional targets in areas important to the regime. Katz warning the Islamic Republic will pay a, quote, heavy price. And China has launched investigations into U.S. trade practices. It follows similar moves taken by the U.S. against China that the Trump administration launched after his tariff agenda was upended by a Supreme Court ruling. It comes days after the White House announced President Trump will travel to China in mid-May. That's your Bloomberg Brief. John?
Yeah, Hira, thank you. Appreciate the update. Up next on the programme, the Morning Calls Plus, Kylie Cohu of Jefferies with the war in Iran weighing on consumer sentiment. We'll break it down, what it means for the consumer and what it means for consumer-facing companies. From New York City this morning, good morning.
$150 price of oil per barrel starts to bring in the recession risk much more prominently. But the equity market here is actually the wild card. The equity market would have to start pricing in downdraft in earnings. It would have to shake confidence of CEOs and on the consumer side, and you would have to see that foundation really become rocky before we're starting to talk about Fed easing here.
Down almost 6% for the month so far on the equity market on the S&P 500. That was Joe Davis of Vanguard. Yesterday, the biggest one-day loss we've seen since this war started. Some negative follow-through here on the S&P, on the Nasdaq, on the Russell was softer by 0.5%. On the S&P, on the Nasdaq, down by 0.6. In the bond market, we keep going back to it. We've had some sloppy auctions this week. 2-year, 5-year and 7-year, 3 for 3. Yields up this morning by 4 basis points, 4.46. And of course, Lisa, what's notable about this is yields are basically back to where they were on Monday morning before the president said there were talks with Iran.
There have been no developments that have removed the uncertainty around Fed policy and around ECB policy. And you still see a complete volatility in bond market pricing. I mean, even the MOVE index, the implied volatility going forward, creeping ever higher. How do you get ahead of this? I mean, the idea that Bob Michael was saying this is technical. How is anyone going to step in and say, I have any conviction to buy?
Technical, fundamental, I tell you what, it's painful. It's painful. It's not what the market was positioned for. That's for sure in the bond market or foreign exchange. Let's finish on crude. 111 on Brent, 97 on WTI, pushing higher by some 3%. Persistence is the problem. How many times have we said that this morning? And the president's basically just told us new self-imposed deadline. This will persist. See you on April 6th.
Yeah, living in purgatory at the moment, basically, for the crude market. You have this environment where even Qatar Energy, when it comes to LNG, they're talking about force majeure, people close to the matter telling Bloomberg. And then still, the Strait, what you see right now is just 1 or 2 vessels, 3 or 4 a day getting through. This is so low compared to where we were before the war, where more than 100 vessels went in and out unimpeded whenever they wanted. Until that opens up, you're going to see prices at minimum this level, maybe higher.
Brent, lingering around 111 this morning. Let's get you some morning calls. First up, JPMorgan raising its price target on Halliburton to 40, expecting limited impact from the Iran war in its first quarter. The second call from Wells Fargo boosting its price target on Alphabet to 397, seeing higher compute and the opportunity for new profit sources. That stock's still lower by 1%. What a rough ride it's been for tech recently. And finally, Mizuho raising its price target on Carnival to 39, saying current levels underappreciate long-term earnings power. That name is down by 1.7%. Fuel and travel is a problem right now, Bramo.
Every time I feel like someone's trolling you, though, when you put up the cruise liners.
The cruise stuff?
Yeah, I just feel like, look, they are under pressure. Who's going to be the winner? Well, clearly it's going to be some of the big guys, which you see potentially consolidating the power of the seas, getting John on the cruise ship.
Mrs. Ferro was trolling me the other day. She brought up the prospect of a Disney cruise.
I think that you should go.
Absolutely not.
I think that in about a couple years you'll be
chance.
seeking somebody to entertain the
in
child.
fact, I can't think of a single person in the Ferro family who wants to go on a cruise, to be honest with you.
I think that maybe you might change in 2 years.
Yesterday in the press room, I heard The Atlantic, the magazine, is doing a tie-up for a luxury cruise.
Good for them.
And like hang out with some editors and journalists. I'm not really sure that's a vacation.
I cannot think of anything worse than that, to be honest with you. All right. Retailers competing with high gasoline prices. The national average still hovering near $4 per gallon. The team over at Jefferies writing expectations were largely transfixed on consumer tax relief, bolstering the physical economy. However, driven by the conflict in the Middle East, investors have been forced to quickly reframe expectations. Kylie Cohu of Jefferies joins us now for more. Kylie, good morning.
Hey, good morning. Thanks for having me.
How have you reframed expectations since this war started?
Well, what haven't we reframed, right? So coming into the year, one of our biggest fears really in the retail space was disinflation. That has completely been thrown out the window. And now the real input is where are costs going, where are prices going, and how is the consumer responding? Right now, we haven't seen any major changes in volumes as a whole, but to use the buzzword of the last 24 months, this K-shaped economy is real, and this could catch up with us sooner rather than later.
The biggest surprise for me would be, Bramo, I'd love your thoughts on this, the opposite happening, which is people got the tax refunds, they've got this confidence, you don't see it in the sentiment numbers, but they keep on spending. And that's essentially what Torsten Slok of Apollo is making an argument for. That would be the shocker. Think about what everyone's calling for right now. No second-order effects because the labour market's not as tight, the consumer's not as strong. That would be the major surprise for the year ahead if actually the consumer stares down these prices and keeps on spending.
Especially if you get policy panic like the one that Michael Hartnett is talking about to juice the economy heading into the midterms. That leads to an inflationary pop, really bad for bonds, but potentially really good for some of these consumer-facing names, which is exactly what Michael Hartnett was pointing out.
So, Kylie, a little bit later this morning, we get UMich consumer sentiment. I'm not expecting it to be any good. We know UMich is shaped by energy prices to a greater extent. What are people doing, though? Your channel checks, the visibility on the consumer, the spending right now, the momentum we had into 26, has it held up?
So far, yes. What we are seeing, I was walking a Target last night. Almost all of the Easter decor is gone. So kind of all these seasonal trends that we started to see are still playing out. People are still spending in pockets where it might have been light, say something like a toys. I cover that space as well. Still looks kind of light. The inventory's there. It maybe not be moving as much. So to your point, we haven't seen the big shift yet. What I think people are most concerned about is the prolonged effect of this, right? So, when I'm thinking about peak shipping times for those more discretionary goods, that's where we start to talking about some timing risk.
So near term, you're starting to hear some consumer-facing brands raising prices, the airlines in particular. We were talking with United earlier this week, talking about the potential for a 20% increase in fares in response to the hit that they're experiencing from oil prices. Do you think that there is a counterintuitive shift where suddenly some of these retailers have pricing power because they can say, look, we're dealing with supply shocks. You're experiencing this throughout the universe, but you guys are getting tax refunds. You're still going to keep buying. We can nudge up prices to compensate for increased costs.
Well, that kind of goes back to the point of the biggest fear was disinflation. And now all of a sudden, wait, do we have a little bit of room here, especially for some of these items that are new, innovative, things like that, that the consumer was already drawing towards. What we also see, though, is consumers are becoming more choiceful. So what they might say is, okay, it's the buzz term, right?
Kylie, we throw people out the studio for choice.
I was waiting for
shut it down.
Yeah. Well, I say that though to say that we're going to see maybe more private label mix, things like that. And really, like I said, in terms of units, in terms of overall spend in stores, we haven't seen any major changes yet.
So what are you telling clients when they come to you and they say, okay, so is this a good time or a terrible time for consumer-facing stocks? Do you just look at them, shake your head and say, I have no clue. Why don't you just check the price of oil and get back to me in a week?
Not quite. We do have more of a view, like I said, that the trends that were happening are continuing to play out. The big are getting bigger. Again, we're very bullish on Walmart. And although that stock has seen a little bit of pressure lately, you're still going to end up seeing those structural moves into the players that were gaining share before this.
I was struck a few weeks ago when Ulta Beauty came out, and it was just after the war started, and said that there's geopolitical risks. This is a makeup brand, like a makeup store. Do you think that in this environment you can see like winners and losers, those that are just maybe using this as an excuse because there's underlying issues at their company?
There could be, and that's definitely been topical with some conversations I've been having with investors specifically. I specifically just cut numbers for toys, and they were kind of calling some of this stuff to be tariff related. And some people think that it's read-throughs to just maybe being weaker demand, maybe, more input costs. So yeah, there are kind of some puts and takes of what are we kind of covering up here, what's real, what's structural. And truthfully, right now, everyone's kind of responding in different ways. We're not sure what the long term is. So no, there's definitely pockets where we're positive, but who knows?
Kylie, good to see you. The problems continue. Kylie Cohu there of Jefferies on some of the retailers right now and the shock to the consumer and the data. Potentially the data, a real shock to the data. What is March and April going to look like? I think we've got a decent idea of what the price pressures will look like, but what about the output numbers? What about unemployment and payrolls over the next week?
Yeah, next week we get JOLTS, we get payrolls, we get the ADP numbers. That's all going to be incredibly important given the fact that so far initial jobless claims have not ticked up. You haven't seen real pressure there. Is there going to be the ability to, as John tells us every single day, go to your boss and tell him you want a raise?
You should always ask for a raise.
All right, I'm going to blame you.
Know your worth, Bramo.
Okay, all right, thank you.
Always back yourself.
Is anyone listening to this? Hey, Rachel.
Never allow your employer to think that labour market conditions have deteriorated. You should also always let them know you've got options, that you can always go somewhere else.
Single-handedly creating
and get
a
more
wage
money.
price
Of course you should. Everybody
John.
should do that. Coming up on the programme, Michael Gapen of Morgan Stanley. Mike does that. Still expecting 2 interest rate cuts later this year. We'll get his thoughts in just a moment. From New York, you're watching Bloomberg TV. The president extending talks and with it extending uncertainty. If I asked you to guess this week, what's crude done on the week, would you guess that it's lower on the week? Crude is lower on the week. It's up on the session by about 3%, 111 on Brent. But it's these levels that are the problem. And we've talked about it all morning. You don't need crude to go much higher from here. Just holding on to these levels is sufficient enough to cause problems. And you're seeing those problems. Cross-asset. Turn to the equity market. Yesterday, biggest one-day loss on the S&P 500 so far for the month of March since this war started. We come into Friday at 7-month lows, the lowest since early September. Futures extending losses, down another 0.4% on the S&P, on the Nasdaq by 0.6. In the bond market, unlocking higher bond yields, pushing higher again. The 10-year bond yield up 5 basis points, 446 on 10s. Where were we on Monday morning? Lower than where we are right now. So even the diplomatic effort has not turned around the story. in fixed income.
I'm laughing because you say that oil prices are lower today than they were when we started the trading session on Monday. And it makes me think of King Dakar, which is this roller coaster in Six Flags. If you have kids and have ever brought them there, it's sort of you begin and you end in the same spot. But the ride in between matters, especially if you get sick to your stomach. And it seems like that is adding a risk premium to every single asset class, which is the reason why Russ Koesterich said at this moment, nothing seems to be working.
We have a physical problem, not a paper issue. So you can push around paper markets all you like. We saw that on Monday morning. But you haven't addressed the physical problem. And you can't address the physical problem with verbal intervention alone. That's the issue that policymakers and officials have got right now.
Because we do not control the Strait of Hormuz. And this crisis just shows that this threat that Iran has always said, that this leverage they use across the global economy, they're actually using it. And today you see it. The IRGC is turning around ships. You're even seeing Chinese vessels having to take U-turns. They are not getting through. How do you address that? Potentially the military operation, which is why the Wall Street Journal is talking about they're even weighing sending 10,000 more troops on top of the Marines and the 86 Airborne Division they already have deployed.
3 options, 3 doors. Which door are you going to walk through right now? The resolution to a positive outcome, a positive future, door number 1. Door number 2, escalation risk. Things get a whole lot worse from here. You start hitting energy plants. You see retaliation across Gulf nations. They get pulled in. Terrible stuff. Door number 3, far more complicated. The status quo, the new status quo. That these problems just linger. This persists through the next several months.
I picked door number 1, just letting you know.
I hope I'm there with you.
I think that increasingly, though, people are thinking about what door number 3 looks like, and let alone door number 2. And the question of something that Morgan Stanley's talked about, the non-linearities, the idea that once you get past a certain point, suddenly the pain gets much more severe, not in a linear fashion.
We'll talk to Morgan Stanley about that in just a moment. This is how the stage is set going into the opening bell. 1 hour away from the cash open. Futures negative by 0.4%. With an update on some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. Adding to the not so very good day yesterday and the not so very good morning this morning is a sell-off we're seeing in tech. It started, at least it was attributed to this new announcement from Google about compressing the need for memory. But it feels like it's taking a life of its own because you continue to see SanDisk and Western Digital down this morning. Micron down less, but still down 0.5%. They're down 15% so far this week. We're also seeing a lot of the software names sell off this morning. CrowdStrike is down. Palo Alto is down. Microsoft is down. There's a lot of speculation that hedge funds had started to short cover in this war when they tried to get low to the ground. Maybe that short covering is over and they're reloading up on those negative bets. Elsewhere, AstraZeneca, that is trading to the upside. Releasing a study around a treatment for a deadly lung disease, the results of which are being interpreted as very positive. Bloomberg Intelligence says that this is an addressable market as big as $10 billion, so shares up just about 3.75%. Wrapping things up with Carnival, we should hear from them in about 45 minutes time for their earnings. It's had a very bad month. Since the war has broken out, they are down nearly 20% for their worst month since 2022. The concern, both consumer appetite and higher fuel prices. What will they say on their earnings call? Shares already negative ahead of it, down 1.7%. John.
Danny, thank you. Thanks for the update. Look out for Danny alongside Matt Miller at the top of the hour, about 25 minutes from now, to guide you into the opening bell. Turning to the economy, lots of data coming up over the next hour or so. Consumer sentiment numbers we need to talk about, and Fed officials warnings on inflation following this war and this spike in crude prices. Mike McKee has more. Morning, Mike.
Morning, John. Any of you guys remember Muzak, the people who, in theory, invented the hold music for telephone? Well, Muzak is now Fed speak because we're seeing everybody at the Fed put the central bank on hold for right now. We had 3 more members last night, all of them on the Board of Governors, saying they're worried about inflation and there's no reason to do anything about interest rates right now. Lisa Cook, I would argue that the inflation risk is greater right now as a result of the Iran war. With respect to the labor market, I see it as being in balance, but precariously so. Joined by Michael Barr. The spike in energy prices and other commodities could have broader implications for both prices and economic activity. And then Philip Jefferson, the Federal Reserve Vice Chair, an extended bout of elevated energy prices could put upward price pressure on a variety of other products. Now, nobody is talking rate increase at the moment, but they are setting the stage for Wall Street to start worrying about it. And what's really interesting, you go back a couple of weeks, This is not what the chart of Fed funds futures look like. Right now, all of the futures are basically pricing in out to 2027 rate increases of one level or another. We're not there for a full rate increase yet, but the graph has turned around. Everything, all those bars were going down before. Now they're all going up. Joining them in their concern about inflation, but not as bad as Wall Street economists. The Bloomberg survey of economists out this morning shows that they expect 2026 PCE inflation of 3.1%. That's up from last month's estimate of 2.6%, a big jump. Not a lot of change in unemployment. And they're still forecasting 2 rate cuts, but recession odds have risen a little bit. So the Fed on hold, and right now, nobody really knows what's going to happen, but the economists are a little more optimistic about rate cuts when we get to the end of the year than it looks like Wall Street investors are.
And Mike, you know how much I respect you, but I have to concede I didn't listen to a word of anything you just said because I was searching for Muzak.
Really?
On the internet, yeah.
Music? You didn't know what Muzak was?
I didn't know what the brand Muzak was, no.
Oh, my goodness.
I grew up in the UK.
Yeah, but
so
you probably were exposed to it as well.
Idea. I was exposed to it, sure, but I didn't know where
There's music absolutely everywhere.
It's
fantastic.
Yeah,
I think it's
Mike,
making a comeback.
Appreciate it. Mike McKee there. Did you know what that was?
Nope, and I just was sitting there wondering how long did it take Mike McKee to come out with that?
Oh my God.
You know, that gem of the morning.
Hold on a second. How could you guys possibly not know what Muzak is?
Well, I live somewhere else.
Yes.
And Anne-Marie's on a different side of 40.
Oh,
right. So,
let's move on.
So there you go. Mike Gapen of Morgan Stanley with this to say. In light of higher oil prices, we revise our outlook for 26 in favour of less growth, more inflation, higher unemployment and later Fed cuts. We now project 25 basis point rate cuts in September and December. Mike joins us now for more. Mike, good morning.
Good morning.
Good to see you, buddy. Let's talk about your 3 scenarios because we've been talking about it all morning. We've been obsessed in this market over two-way risks. Mm-hmm. The prospect that prices go a lot higher from here or they go a lot lower from here. There is a middle ground. Can you go through the 3 scenarios for us and what it might mean for Fed policy?
Yeah, I think as you alluded to in the last segment, door number 1 is uncertainty diminishes, risk, walks back, oil comes back down. So we return to where we were kind of pre-February 28th. And as you said, in the other direction, door number 3 is oil goes a lot higher and kind of clearly triggers nonlinearities and it weakens demand. And the labor market and activity clearly suffered. The door number 2 is that kind of in-between scenario where oil stays elevated for a long time. So there's lingering term premium in the oil market. And it's hard to know what to do as a central bank policymaker in these worlds. And because oil up to a certain level is mainly an inflation story. And so you want to lean against that. And the Fed already seeing its policy rate as being restrictive, that's a Fed that's probably on hold for the foreseeable future. But somewhere in there, if oil goes high enough and activity weakens, the Fed may want to cut. So there is a convexity. We think it's around $125 a barrel. That as you move above that, you'll probably start seeing demand for oil and other products be destroyed. So we don't know quite where that level is, but that's the idea. Some oil means some inflation, means at least the Fed on hold for a prolonged period of time. Our forecast is in that world, the unemployment rate drifts a little higher and the Fed turns to rate cuts later this year. But that's, we'll see how that goes.
We're kind of in the middle window right now.
Right. The problem
window. Can we talk about where we are now and the prospect for a broadening out of price pressure? When you're around 110, 111, from the 60s, from the 70s, and you spike up that quickly, what is the prospect of the bleed through to other prices?
Well, the standard analysis here is you don't get bleed through to other prices, right? So the kind of the last 35 or so year history of the U.S. is that oil will be a headline inflation story. It destroys demand on the other side, therefore it doesn't pass through to core. So the history says you probably won't get it. But the story where you might get it is a combination of, well, we're 5 years above the 2% target. This is our 3rd kind of consecutive supply shock. Is it the case that there will be second round effects, either because firms are seeing higher input costs, right? So in one way, there's a price story here, but there's also a quantity story. In the U.S., oil's available at a price. In other parts of the world, it's getting to the point where, as you noted, the difference between paper oil and physical oil, if physical oil starts to become a problem, then you start to get kind of supply chain disruptions like we saw in the pandemic. That could kind of create second round effects on core inflation that you would not expect from a econometric exercise where oil goes up and then oil comes back down. So the longer it stays at 110, the more you start to risk second round effects.
Especially if the economy is as hot as Torsten Slok over at Apollo seems to think that it is. I mean, one of the complications here is the complete disagreement about the state of the labor market and the state of the U.S. economy heading into this period. How important is next week's employment report going to be to give a sense of how much wage inflation there is potentially, how tight the labor market actually is?
Well, that, as you know, the survey for that would be taken around March 12th, the middle of the month, only about 2 weeks into the uncertainty that we've been seeing. So I don't anticipate that it's, say, a clean reading on what the labor market looks kind of post-Middle East conflict. So we're expecting, I think, a pretty decent report because we'll get some payback from the workers who are on strike and some of the weather. We think 60 to 70,000. So I don't think you're going to see a lot out of it yet. That's probably more the April employment report. And the retail sales data coming, it's delayed. It's, we need timely data. We're not getting it. But the analysis suggests that oil price shocks tend to hit spending on goods more than anything else. So I think that one will be critical. And the other thing I'm watching is the inflation swap data, meaning the inflation market, I think, is a very good indicator for when we might hit that nonlinearity in oil prices. So a year ago, after Liberation Day, when tariffs were very high, one year inflation swaps went down. So it was an indication that the market saw those tariffs as embargo-level tariffs, and activity would fall and inflation would come down. So far, that hasn't happened in the current volatility. One year inflation swaps have generally moved up. So that is kind of a trigger point or an indicator I'm watching for maybe when financial markets think oil prices have gone too high.
There's also the issue that financial markets have started to feel some moderate constraint, particularly in the bond space. And you start to see some real pushback around levels across the curve. At what point is that enough to crimp growth in and of itself, to act as sort of a constraint on how high inflation could go? Well,
I think we're there because we made revisions in that direction, taking some of this into account. So I do think financial conditions have tightened anywhere on the equivalent of about 2 federal funds rate hikes. So bond spreads have moved up. Oil, of course, has moved up. The dollar has moved up. Equities have moved down. You combine all of that, and it is probably the market is doing the Fed's work for it now. So I would say we're there, and we've taken some of that into account into our revisions.
You're getting some feedback from Bloomberg subscribers. Most likely there's no data that's super important now. This third supply shock, trade, labour, now energy, has lasted too long to just assume it away. The backward-looking stuff is even more backward-looking.
Which a lot of people would agree with, and we've been getting data, and people point to it, and it makes no difference whatsoever in markets. Is there, though, a difference if you do get a sense that there is a heating up of the labor market, that potentially this could lead to a greater wage price type of reaction to what we're seeing with respect to the oil price shock?
I always think that shocks like this bring the best out of research teams on Wall Street. Really enjoyed the work from the team over at Morgan Stanley. Mike, thank you. Mike Gapen there of Morgan Stanley. Let's give you an update on news worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Anthropic considering going public as early as October. Sources telling us here at Bloomberg, the maker of the Claude chatbot is in talks with Goldman Sachs, JPMorgan, and Morgan Stanley about playing a key role in its listing. The information reporting an Anthropic IPO could raise more than $60 billion. Baseball is back. The Mets off to a hot start after beating the Pirates 11-7. Milwaukee dominating the White Sox, scoring 14 runs and striking out 20 batters. And the defending champion, the Dodgers, beating the Arizona Diamondbacks 8-2. And Netflix announcing it's raising prices across the board. The streaming giant's subscription with ads will now be $8.99 a month, with the premium plan increasing $2 to $26.99 a month. This marks Netflix's first price hike in over a year, and is effective immediately for new customers. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, Ajay Rajadhyaksha of Barclays joins us on the widening cracks in the US economy, and we've got to get his view on why they upgraded their outlook for US equities in the last week. Barclays pushing their price target on the S&P higher. That conversation up next.
Things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. Right now, we're still not expecting recession. You have to go well north of $120 a barrel for a recession. So in the meantime, just let the markets go to wherever they're going.
In the meantime, as we've said a few times already this week, it feels like trying to catch a falling chainsaw. That was Bob Michael of JPMorgan Asset Management. Equities this morning, negative once again, inching closer to the cash open. The open about 41 minutes away. On the equity market right now, we're negative by 0.5% on the S&P, down 0.75 on the Nasdaq. In the bond market, yields bleeding higher. At the long end, 10's up by 5. The 10-year this morning, 4.46. And in commodities, Brent WTI looks like this. Are we going to have another weekend where Monday morning starts Sunday evening?
Please not.
When the oil market opens up. Brent crude, 110.86. WTI, just short of 97.
Probably. I mean, based on
Feels
the
that way,
record, right? Ultimately, people are still going to be logged in, regardless of whether there's any news over the weekend, because this is going to set the tone for the rest of at least Monday morning.
Set the scene. You run research at a bank, and your equity strategist knocks the door. You open it. What do you want? I'm busy. And then they say, I want to raise the outlook for our price target on the S&P 500. And you say there's a war. What's wrong with you? Let's have that conversation right now with Ajay Rajadhyaksha of Barclays. Ajay, good to see you.
Well, I wish I could say the same, but thank you for that.
So that happened in the last week with the team at Barclays. Your chief strategist, your equity strategist, comes to you and says, let's raise the outlook for stocks. Give me an idea of what that conversation sounded like.
So, honestly, those numbers are not built on air. The bottoms-up consensus analyst estimates, you know, there's an analyst at each shop with a bunch of juniors who follows every major name, right? They do channel checks, they do what the guidance looks like, etc. The bottoms-up analyst estimates for S&P 500 show the strongest year-over-year rebound if you exclude the post-COVID rebound. And the numbers are the numbers. I mean, you know, we sometimes tend to be too fixated, tend to extrapolate too much what is happening in the here and now.
Sure.
Take 9/11, which was about as existential as can be, right? I mean, we were completely shell-shocked as a nation, as individuals. 3 months later, the S&P 500 was up 2.5%. 13% higher the day boots went on the ground in Iraq during the Second World War. 60% higher since the Russians invaded Ukraine.
So are we underestimating second-order effects here? If you're saying the outlook for growth is pretty good, I'm wondering what the outlook for inflation is with crude at these levels.
I think Governor Waller said it best. If you remember, 2 or 3 weeks ago, his initial response was that this is a one-time shift in the price level. Base effects are a central banker's best friend. Unless you think that this leads to the Fed losing inflation credibility. And honestly, guys, if the Fed didn't lose inflation credibility when headline ran at 8% for 2 straight years, it's not doing it now. You know, there's no reason to. The Fed hiking is not going to get oil to flow more freely. They are going to sit this out.
Are people overly conditioned by previous crises of confidence where you did see big drawdowns in the market, that there can be a policy response that offsets any of the potential downdraft to growth?
I think that is a fair pushback. I don't think most people believe that now because everyone realizes that a policy response doesn't help get ships faster through the strait. A policy response doesn't help really offset demand destruction. If oil goes to $150 a barrel, right, there is an element of demand destruction, and the policy response doesn't help with that. So I don't think the market is counting on that. I think there's 2 things that the market is counting on. One is the energy intensity of the world economy is significantly lower than it was 10 years ago, 15 years ago, 20 years ago. The second is that $100 a barrel of oil is not the same thing as $100 in 2022, let alone 2011. And I'll remind you, we were there in 2011. We had a ton of inflation since then. And then finally, the world's largest economy is a gigantic energy superpower. We shouldn't forget that.
Well, this all comes along with the often pushback against the bears that the technology story is strong and that the U.S. is the epicenter of a lot of it, but the tech story hasn't been working. And that raises a real problem for people who are banking on the AI investment structure. I mean, how solid is that, especially in light of tightening financial conditions in the face of this oil shock?
It's incredibly solid. I would argue that the AI capex cycle is a cyclical. I agree with you, Lisa. It's not been working for the last 4 to 6 weeks because we have all been like a deer in headlights caught when it comes to Iran. That's happened before. 2023, SVB goes under. For 6 straight weeks, the only thing you and I were checking was a regional bank ETF. Tiny, but we shouldn't have. The bond market felt like the Fed would cut 100 basis points that year. Remember how many times the Fed cut? 0. We grew at almost 3% Q4 over Q4, just effortlessly shrugged it off. So there tends to be a tendency to extrapolate. What I know are the numbers. I know Satya coming out and saying that the cloud computing backlog in Q4 was $368 billion. I know that Google Cloud is going up 50% year over year. And Pichai is still telling us that their backlog is $240 billion. Those are real numbers. You can't wish them away.
Could you have $150 oil or $200 oil and still have your outlook?
No, then I'm just wrong. I mean, if we are here in 2 months...
But that's what the energy world is saying, because that's where the physical market is.
But you are supposed to look, the forwards are the collective cleanest indicator, unless you believe that there's this gigantic conspiracy, right, where every government sitting around the world is paying futures down hard.
Some people do, but yeah, carry on.
Yeah.
Yeah, but see, Stan Druckenmiller, his first mentor, had this phrase, 60 million Frenchmen cannot be wrong, which is, I'm assuming the guy was French. But the point was that the base case tends to be true 80 to 90% of the time. Markets do a poor job pricing in a tail for obvious reasons.
Yeah.
But in general, it doesn't pay to be a contrarian. And at this point, I think things are nowhere near as bad as people think, which is why the equity market, the S&P, is down only 7 to 8% from its all-time high. That's not a big move.
This was, at risk of offending a lot of people this week, my favourite conversation this week. Thanks for being here, sir. Thank you. Thank you. You tell him. Ajay Rajadhyaksha there of Barclays. Thank you, sir. Coming up on Monday, it's going to be another long weekend. Monday, of course, starts Sunday evening. Look out for the coverage out of Asia on Sunday evening. Coming up on Monday, Laurie Cavacina of RBC, Vinu Krishna of Barclays on that equity call, Bob McNally of Rapidan Energy, Osen Kwan of Wells Fargo. From New York City this morning, good morning. This was Bloomberg Surveillance.